further below zero, adding to the case that the ECB may need to do more. Christine Lagarde speaks in 30 minutes' time. And Shell will shed up to 9,000 jobs. COVID-19 forces a company-wide restructuring of the Anglo-Dutch company as it moves into low-carbon energy. Futures then suggesting we'll move to the downside. A lot of time for markets to reflect then on what we heard in the first presidential debate. Futures in the US actually moved higher during the debate, but towards the end where we started to be made a little concerned about a handover of power, whether that would be orderly if it were dictated by the US people, then that seemed to weigh on the minds of investors, weigh on markets, and so we saw US futures move to the downside. As we see these European equity markets open up, I should just point out US futures are still negative, but they're off lows, so we are down 1% on NASDAQ futures, but that's not down 1.4 as we were earlier on in the European trading day. So European equity markets then opening to the downside. Stock 600 down 0.5%, the FTSE 100 down around 0.6%, the CAC 40, as we saw in futures, underperforming the rest, so down by around 0.8%, the IBEX down by a similar margin. So we do see US futures lower, we see European equity markets lower. This comes as the first Trump-Biden presidential debate highlighted the risk of a contested vote.
Everybody knows he's a liar.
But you
I just want to make sure.
Joe, you're the liar.
I want to make sure.
You graduated last in your class, not first in your class.
I want to make
Mr.
sure.
Mr. President, can you let him finish, sir?
No, he doesn't know how to do that. He has,
You'd be surprised.
You pick
You'd be surprised.
the
Go ahead,
wrong
Joe.
guy, the wrong night at the wrong time.
Listen.
For more on the debate itself, let's get to Bloomberg's Kayleigh Lines, who's been up all night following the action from New York. Kayleigh, what were the primary takeaways then, and what are the implications? What does it mean for the presidential race?
Well, Anna, as we just heard there, this was a very messy, undignified debate in many ways. The two candidates repeatedly interrupting each other. President Trump often talking right over candidate Joe Biden, who at one point told the president to shut up. He called him a clown. He called him a racist and the worst president America has ever had. While Trump, for his part, attacked Biden on his intelligence and on allegations surrounding his son, Hunter Biden. Really, generally, Anna, this was just a lot of noise, not a lot of policy. They did cover a range of issues from healthcare and the virus to the Supreme Court and election integrity, but really the candidates stuck to talking points we've already heard them from, and again, this was just a lot of noise. And what that means is that many pundits are saying that this debate probably didn't change a lot of minds. I do want to point to a CBS poll that came out right after the debate. 69% of people in that poll said it left them annoyed, and 48% of those said Biden won. And that it really is a key question here, because remember, Anna, Biden was leading in the polls, not just nationally, but in key swing states going into this debate. President Trump is playing a game of catch-up here, and 42% of voters in that poll said that their opinion of the president is it made them think worse of him after this debate. Now, as far as what happens going forward, we are expecting 2 more presidential debates in the month of October. Will they happen after tonight's messy debate is a key question. And then, of course, we have to look ahead to November 3rd, the contested election possibly that we're in store for, as the president once again casting doubt on mail-in ballots tonight, Anna.
Yeah, will it be contested then? Kayleigh, thanks very much. Thanks for bringing us the update. Bloomberg's Kayleigh Lines in New York. Joining us now for a market perspective, John Rowe, Legal and General Investment Management Head of Multi-Asset Funds. John, good morning to you then. As we digest the latest lines, the toing and froing of the first presidential debate, and we move closer to November and the vote itself, are you focused on the policy platforms of the various candidates? Are you preoccupied by the near-term volatility that we expect?
So I think the policy platforms probably don't matter that much, because in reality the two are so polarized, and also the non-traditional style of Donald Trump does mean that his whole aim is to try and turn it into a personality contest. So he owns the news cycle. I thought Joe Biden did very, very well yesterday, because he stopped Donald Trump owning the news cycle, and it's Trump who needs to make the catch up. So going into it, a lot of the talk, a lot of the concern was, would Biden show any weakness when Trump tried to bully him, and instead he just turned the whole thing into a messy outcome, which I think is better than he could have hoped for on the way in. We all knew Trump would take that approach, and the risk was that Biden looked weak, and instead of that he said, well, I'm not going to let you hold the headlines, which I think is very important. In terms of what's
Do you think
driving
the
the shorter term,
Yeah, I was just going to ask, in terms of what's driving the short-term volatility, how long do you think volatility lasts? I guess it depends if we end up in with a contested outcome.
so I think over the next month, yes. Before that, there's a whole kind of European issue, which is really around the virus, and then in the US, the likelihood of a stimulus package. That's probably a 1 in 4 is where the market's putting it on the US stimulus package. I would say the risks to that are to the upside, and the reason for that being that Donald Trump is clearly keen to do a deal, and he doesn't want to increase the risk of equity weakness into the election, given he's used it as this very important gauge of his success. So yes, there's a long gap on the stimulus package between the two sides, but at least Trump himself is keen to try to get a deal done. So I would say that in the US, before the election, it becomes about the stimulus, and then actually there's this much bigger issue in Europe around the virus.
Yeah, really interesting. Is there some sort of White House put then under equity markets right now when it comes to fiscal stimulus in the US? John, our last guest said 30% chance of stimulus before the election. I think you've talked about 25% perhaps in the past. From what you've said there, though, if the president really doesn't want to see an equity market sell off, maybe there's a higher chance of getting something through before November.
Yes, I would say the risks are to the upside, and he has had some success in the past convincing the Republican Party to go in his direction. So as long as he remains competitive in the polls and the Republican Party don't see it as being about positioning for the next election or for the future and for their more traditional base, then I think there's a better than 25% chance that we do get that stimulus package, that the risks are to the upside.
So that's where the risk is. The risk lies to the upside. In terms of your strategy then, John, I know that you're short investment grade credit. How does that sit with what we've been talking about? And how does that sit with the Fed's policy of being in that market quite extensively?
So it's really that there's a lot of uncertainty out there, and you can see that with the levels of the VIX and also the recent price movements in equities. And the problem for us with investment grade is that it offers relatively limited upside. Around 80% to 85% of the credit spread widening we've seen this year has already been retraced. So there isn't really that much more upside left, whereas of course there's almost infinite downside. Yes, the Fed can step in, but it's a very asymmetric asset class from here in our perspective, with a limited amount of upside and a much larger downside. Whereas when you look at that in equities, of course, there's plenty more potential for equities to rise or fall. It's a much more symmetric asset class from here. The same is true in terms of high yield. And so it's those kind of areas that we think offer better risk reward in the current environment.
Okay, John, thanks very much. That's one of John's conviction trades. We'll get to more of those. John Rowe from Legal & General Investment Management, head of multi-asset funds. He stays with us on the programme. About 20 minutes, in about 20 minutes' time, we'll be crossing over to Frankfurt, where Christine Lagarde will be speaking at the ECB and its Watchers event. Really interesting to gauge her willingness to do more around the coronavirus, given the resurgence that we're seeing in COVID-19 across the European continent. We'll bring you that speech live, of course, when she takes to the stage in around 20 minutes' time. This is Bloomberg. Welcome back to the European Market Open. This Wednesday morning, 10 minutes into a trading session that looks negative for European equity markets. We're not down by much on the London market, though. The FTSE 100 currently down, as you can see there, by, in fact, flat, just turning flat on the FTSE 100 this morning. US futures do point to the downside, but off earlier lows. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Disney is slashing 28,000 jobs in its slumping US resort business. It's one of the deepest cuts of the COVID-19 era. The move affects the company's theme park, cruise line and retail businesses, 67% of those being terminated as part-time workers. Some Disney parks are now open, but it still hasn't got clearance to restart operations at its flagship resorts in California. Wall Street banks complaining about trading venues charging high prices for data have a new ally. Donald Trump's chief competition watchdog, the Justice Department's antitrust division, says it's paying close attention, adding it will pursue any anti-competitive conduct on Wall Street. By the way, Bloomberg News' parent company is among the firms that have contested fee increases for data. JP Morgan has admitted wrongdoing and agreed to pay more than $920 million over spoofing claims. It's the largest sanction ever tied to the practice and involved 15 traders over 2 of the bank's desks. The Justice Department is deferring prosecution on 2 cases of wire fraud. As part of the deal, JP Morgan will report its compliance efforts to the government. That's your Bloomberg Business Flash. Anna.
Right, in London with your Business Flash. Let's get to the UK economic picture, because Britain saved a record amount during the second quarter. They saved on a record scale during lockdown. The savings ratio soared to 29%. That's coming from the ONS this morning. This data just released this morning paints a stunning picture for savings in the UK. But of course, it's kind of backward looking. That's for the second quarter. What have they done with it since? John Rowe, Legal and General Investment Management Head of Multi-Asset Funds, is still with us. Really interesting to see, and we've seen similar data from the US, where there was plenty of saving happened during lockdown. People could have spent some of that since, as I say, John. But maybe this does give us some comfort as we head into the winter, that some of the Western European economies and indeed the North American economy, the winter can be cushioned slightly by these higher savings rates.
Yeah, so that'll definitely help. It all comes down to people seeing the virus period from here as a limited period, and then they'll be prepared to use more of their savings. The more uncertainty they feel there is over how long this might last, of course, then the less confidence they have and the more conservative they'll be. In the UK, yes, we've seen this soaring savings rate. We haven't seen activity pick up as much as in the biggest countries in the Eurozone. And there has been now this slight concern over the future fiscal plan. Is the new deal to support jobs going to be good enough, going to be enough? It's clearly a lot weaker than the previous deal, and that remains to be seen, but is clearly a risk. There is a risk of insufficient fiscal action in the UK.
A risk of reduced fiscal action. What about the unemployment story then, and what will that do to inflation expectations? Because I know that you are short inflation. Is that the UK? Is that the US? Is that everywhere? And is that because you expect to see unemployment pushing higher and therefore inflation being ever so difficult to generate?
Yeah, so UK unemployment will probably be somewhere between 7.5% and 9%. And so from that perspective, lots of slack in the labour market, which in its turn makes inflation a bit like pushing on a string. So for us, we are kind of short inflation. The UK in particular, actually, the UK offers the worst value in the inflation market. And that's because there's a very large segment of that market, the defined benefit pension scheme side, that's constantly trying to de-risk, constantly trying to buy protection, which drives the prices in the UK a very long way from fair value. It's the only inflation market in the developed side where actually what's priced is well above the central bank's target, whereas in the US, it's even on a forward-looking basis, 0.5% lower than the Fed's target. So we're short inflation, the UK in particular, and then overall, because we do think that there's a co-behavior between inflation and equities in recent times. Inflation expectations tend to pick up with equities, but they'll only pick up so far. So it's another asset class with an asymmetric risk profile, with a bit more potential for inflation expectations to rise, and then plenty of potential for them to fall if we see a setback. So for that reason, we are short inflation, and in particular the UK.
And if Britain saved during the second quarter, John, they certainly didn't spend it on travel and leisure because they had reduced opportunity to do so. You quite like that sector from here. Why is that? Are you not concerned that we go into further lockdown situations in various parts of Europe?
We're definitely concerned, but we think part of that is priced, and also it's a really hated sector, and one of our favourite ways of finding trades is to find something no one's got a good word to say about. And so when we entered travel and leisure a couple of weeks ago, then that was really off the back of a very pessimistic outlook for areas like cruise liners. And for that reason, yes, that's entirely justified, but we feel that leaves plenty of upside if you get small improvements. So, for example, in the US, the CDC is due in October to decide whether or not cruise liners can begin, and any small part of good news can start to be enough. In Germany, a small number of cruises have started and feedback has been very good. So it does go to show there are ways that firms are starting to have success. And with such low expectations, we just think it's the laggard of the laggards, the worst performing of the bad performers. And from that perspective, it actually makes it quite attractive for us from here.
We see German Chancellor Angela Merkel speaking right now in the German parliament, in the Bundestag, and she's saying there are difficult months ahead as infections rise, bringing you live pictures then coming through from Berlin. And John, this just going right to the heart of the questions that lie ahead, I suppose, for Europe. She has said, just as many European leaders have said, that she does not want to go to a full lockdown again, and that term itself has started to mean less and less, hasn't it? Do you think that we managed to avoid something that looked like March and April as we go through the winter here in Europe?
I think we do. I mean, that was a 25 to 35% hit to the economy for as long as it went on. And so it's absolutely essential for these Western European countries they avoid it. It's almost a surprise that it's picked up as quickly as it has. I think you can see that in policymakers' response, that they started to try and open the economy, had been forced into reverse. The closest equivalent would actually be Florida, Arizona, California, and Texas in the US. They managed to bring R0 down, the infection rate, with relatively limited measures, only small impacts on the mobility data and on the activity data, just a few percentage points. And it's really that template that European countries will now be looking for. As soon as one of them cracks it, if they do, it will give much more comfort to the market that others can follow suit. A lot of that will be targeting the areas where the infections are happening. So in the UK, nearly half of infections are currently being related to education, so university and schools. Care homes is a lot more difficult to deal with, but there are these areas where they'll need to start to target incrementally to just get that R0 back down below zero.
John, thanks so much. John Rowe, Legal and General Investment Management Head of Multi-Asset Funds. Really interesting to speak to you this morning, John, and I'll continue my conversation with John Rowe. He joins me on Bloomberg Radio at 9 a.m. UK time this morning. A few more lines coming out from the German Chancellor Angela Merkel. As I said, she's speaking in Berlin. The German Chancellor saying she wants to return to budget normality as soon as possible. So we've seen the German government taking action that many before the pandemic, of course, would have thought was impossible in terms of that black zero and the commitment they have to that in Germany, but certainly she's talking about budget normality, wanting to return to that. We also want to tell you about what's coming up on the program next. We're going to be talking about the oil industry or the energy industry. Shell is cutting up to 9,000 jobs in a virus-induced restructuring. We'll talk about that next. This is Bloomberg.
was asked to bring back Chrysler and General Motors. We brought them back right here in the state of Ohio and Michigan. He blew it. They're gone. He blew it. And in fact, they're going.
Ohio had the best year it's ever had last year. Michigan had the best year they've ever had.
That is not
Many
true.
car companies came in from Germany, from Japan, went to Michigan, went to Ohio.
They're not having
And they didn't come in with you.
Mr. Vice President, go ahead.
And so you take a look at what he's actually done. He's done very little. His trade deals are the same way. He talks about these great trade deals. You know, he talks about the art of the deal. China's perfected the art of the steal. We have a higher deficit with China now than we did before. We have the highest trade deficit
China
with
ate
Mexico.
your lunch. They're
All right,
18%. China ate your lunch, Joe.
That was Donald Trump and Joe Biden discussing U.S. manufacturing and its relationship with China, talking about the trade negotiations that were, of course. Let's quickly check the markets for you. European equity markets are down, but only by 0.2%. The London market, an outperformer today. The FTSE 100 is actually in positive territory right now. The Swiss market not doing bad as well, because the biggest points contribution on the Stoxx 600 to the upside coming through from Nestle. We also see, though, in the London market that Shell is moving to the upside. GlaxoSmithKline, Diageo, some other heavyweights, Anglo-American, HSBC move higher, and that lifts that particular market. Talking of Shell, Shell is cutting up to 9,000 jobs in a virus-induced restructuring. The CEO, Ben van Beurden, said the energy company was moving to be a more streamlined and competitive organization. The revamp is projected to save as much as $2.5 billion by 2023. Joining us now is Laura Hurst, our oil and gas reporter. Laura, why is Shell doing this? How much of this is coronavirus induced, and how much of this is about the long energy transition we were already talking about?
Well, it's a mixed picture for sure. From Shell's perspective, they're saying, look, in April, we outlined this ambition to really slash our emissions and change the nature of our business to become a cleaner company, a more green company. And it seems from their perspective that COVID has simply accelerated the pace of change. So it's not just COVID that caused these redundancies. It's something that the company was gearing to anyway.
And how does this plan from Shell compare to peers in the industry? We heard earlier on this month extensively from BP during BP Week about their plans.
Yeah, so basically we're seeing the majors cutting costs and headcount quite aggressively. And BP said earlier this year that they're going to cut about 10,000 people, so more than Shell. And similarly, Chevron and Exxon have already started cutting headcount as well. So it's becoming quite a standard thing across the industry and across majors.
And what is the outlook for Shell then at this point as it tries to manage this really complex transition, just like others in the sector are doing? What is the outlook for the business?
Well, it's quite a tricky one at the moment. They said this morning that they're going to expect oil product sales come down quite fairly from last year, as that we're still seeing an impact of the coronavirus on demand. And in fact, just yesterday, we heard a lot of the top oil traders from Vitol, Mercuria, Trafigura reflect this feeling that demand is still yet to come and could take another 18 months to go back to where we were before the virus.
Laura, thank you very much. Laura Hurst, our oil and gas reporter, joining us with the latest on Shell. We are going to be bringing you the live speech of the European Central Bank President, Christine Lagarde. She's going to be speaking at an event at the ECB and its Watchers Conference. That is supposed to take place in around 4 minutes' time. We will bring you her speech as she delivers it. It's set to last just over half an hour, so we will get to that. In terms of the movers that we've got in the markets, there are plenty of them. We might have a chance to recap that in just a moment's time. European equity markets were on the back foot in the aftermath of the first of the presidential debates, now making some moves to the upside in London, and the Stoxx 600 is down by just 0.3%. Nasdaq futures off lows down around 0.9%. Up next, then, we will cross to Frankfurt and Christine Lagarde, who will be speaking, as I say, at the ECB event taking place there. We'll bring you that live. This is Bloomberg.
That helps ensure that monetary policy is not forced too often towards the effective lower bound when faced with shocks that push inflation too low. Now, since 2003, as you know, the ECB has used a double key formulation to set our objective, defining price stability as a year-on-year increase in inflation of below 2%, while aiming for inflation of below but close to 2%. And this formulation was perfectly appropriate at a time when the ECB was seeking to establish credibility and too high inflation was its main worry. As our research shows, it was a key factor in successfully capping inflation expectations. But things have changed, and in the current environment of lower inflation, the concern we face are different, and this needs to be reflected in our inflation aim. Ensuring that there is sufficient space above zero to re-empower conventional monetary policy becomes more important. And to underpin inflation expectations, we need to ensure that our aim is perceived to be symmetric by the public. So we should have an inflation aim that is credible and that the public can easily understand. The second issue is the horizon over which price stability should be achieved, which is captured by the ECB's medium-term orientation. This forward-looking orientation reflects traditional and well-established principles of prudent monetary policy, which is consistent with the notion that monetary policy works with a lag and can influence inflation over the medium term rather than the near term. But within the ECB framework, the medium-term orientation has also been a way for the Governing Council to take into account what is happening in the real economy, including employment. We have a hierarchical mandate with price stability at the top. But the medium term, which is a flexible concept, allows us to avoid unnecessarily constricting jobs and growth in the event of a supply shock, which temporarily pushes inflation up and generates an economic slump. The low inflation environment, nonetheless, creates some new questions about how to operationalize the medium term. For instance, the existence of large and persistent disinflationary shocks related to, say, the ability to compare prices more actively via the internet and diversify suppliers is likely to call for more flexibility. But a persistent failure to meet the inflation aim can feed into inflation expectations and would call for a shorter policy horizon. We also need to reflect on our two-pillar approach for assessing developments in the economy, which uses both economic and monetary analysis. Cross-checking between the two helps determine the risks for price stability. The monetary pillar could in principle be enhanced to provide information on financial stability, which over longer time horizons could be relevant for the inflation outlook. Some central banks have also considered adding a backward-looking element to the policy horizon in response to the low inflation environment. In the ECB's case, the reference to underlying inflation dynamics in our forward guidance means that we already look at the past when deciding whether to change policy. The wider discussion today, though, is whether central banks should commit to explicitly make up for inflation misses when they have spent quite some time below their inflation goals. If credible, such a strategy can strengthen the capacity of monetary policy to stabilize the economy when faced with the lower bound. And this is because the promise of inflation overshooting raises inflation expectations and therefore lowers real interest rates. While make-up strategies may be less successful when people are not perfectly rational in their decision, which is probably a good approximation of the reality that we are in, the usefulness of such an approach could be examined. The third issue is the measure of inflation that lie behind our inflation aim. The HICP has served us well so far and is continuously being improved. Examples of these improvements include how it accounts for quality, change, annual changes in consumption weights, more granular categories of expenditure, and timely data. But at the same time, our economies are changing increasingly quickly. We need to keep track of broad concepts of inflation that capture the costs people face in their everyday lives and reflect their perception, including, for instance, measures of owners-occupied housing. Now, it is not about moving the goalpost for monetary policy where it is suitable. It is about future-proofing how we measure inflation. But we also need to recognize that adjustments will have issues in terms of reliability and frequency of data. Likewise, to get a better sense of the evolution of the HICP over the medium term, we need to complement our analysis also by looking at more cyclical and less volatile measures of inflation, such as underlying inflation. The public rightly expects us to defend the purchasing power of money, and that is why we target the overall HICP. But underlying inflation measures are more responsive to economic slack, more to that in a minute, and tend to better predict inflation over the medium term. Let me now turn to the relationship between inflation and the real economy. If the anchor for inflation is the inflation aim, the Phillips curve plays a central role in allowing central banks to steer inflation towards that aim. But in the low inflation environment, prices appear to have become less responsive to the real economy. ECB research suggests that the empirical Phillips curve remains intact, but it may be rather flat, as we have seen. I'm going to borrow from George Bernard Shaw at this point in time. He's the one who said, "The reasonable person adapts themselves to the world. The unreasonable one persists in trying to adapt the world to themselves." And I'm sure that we can all agree that we should try to be reasonable rather than unreasonable. Broadly speaking, three factors might explain why inflation responded so weakly to improvements in the economy in the run-up to the pandemic. The first possibility is that economic slack, that is the amount of underused resources in our economy, was actually larger than we thought. The second possibility is that the relationship between slack and inflation was obscured by persistent structural forces. And the third is that the anchoring of inflation expectations might have loosened, affecting where inflation settles when both demand and supply shocks have passed and slack converges at zero. The intuition behind the first factor, slack, is that the Phillips curve is alive and well, but the euro area faced a series of large shocks that made it harder to measure economic activity relative to potential. And since what matters to move inflation in the Phillips curve is the distance from full employment, if that distance is underestimated, inflation may remain subdued even as measured slack gets smaller. There are numerous potential causes for mismeasurement, including measures of unemployment that ignored the effects of part-time work and underemployment, revisions to potential output which mistook cyclical change for structural trends, or a failure to fully account for external factors that added to euro area slack, such as relative demand imbalances linked to trade surplus. Research supports such a role for hidden slack, and since 2011, studies that assume that the output gap has been much larger have in general outperformed those that use traditional estimates. What is striking, though, is that in the run-up to the pandemic, we saw labor markets slack diminishing and wages finally rising, but without inflation picking up. In fact, ECB research finds that there was no missing wage inflation in the recent years. What we saw instead was a slower pass-through from wages to prices because companies preferred to compress margins rather than pass on cost rises. Now, for monetary policy, it matters whether firms did this because they expected slowing demand or because they were affected by persistent structural changes that distorted historical regularities. And that brings me to my second factor, long-running structural forces. How could they have weakened the link between the real economy and inflation and thereby require a revised approach to monetary policy? It is clear that globalization has lifted the global labor supply, has sharpened competition, and has caused firms to set prices more strategically. Globalization also went hand in hand with digitalization, which increased price transparency and enabled many industries to reduce their costs. In theory, all these factors could have depressed price inflation, even as wage growth was being supported through productivity gains from technology. In parallel, adverse demographics in advanced economies may have led to higher saving rates and structural weaker demand. Research suggests that these forces have affected inflation in the euro area in recent decades. A recent study finds that global factors such as global commodity prices, global slack, and producer price competition can all significantly affect inflation. ECB research also finds that digitalization has been disinflationary in the euro area. Since 2006, e-commerce has led to an average yearly decrease in non-energy industrial goods inflation of 0.06%. And empirical evidence suggests that a shrinking working age population may depress inflation. That's for the disinflationary forces. At the same time, structural forces need not be net deflationary, particularly in the aftermath of the COVID-19 pandemic. While globalization and digitalization have tended to pull in the same direction over the last 20 years, it is conceivable that they might now pull in opposite directions. The pandemic might both trigger deglobalization, as we see protectionism rise and firms shorten their supply chain to increase operational resilience, and accelerate the expansion of the digital economy. Changing global demographics might also reduce the global labor supply. In addition to that, a more active counter-cyclical role for fiscal policy after the pandemic may strengthen inflation dynamics. And we have to factor in a renewed focus on mitigating climate change too. which could have an impact on inflation through progressive changes in the energy mix as we transition towards a carbon neutral economy. Climate change affects all aspects of monetary policy, output and inflation, long-term interest rates and policy transmission, and that is why we are carefully studying the implications of climate change for our primary objective as part of our strategy review. In any event, structural factors can only have a lasting negative impact on inflation if they seep into inflation expectations. And this leads me to the third factor that may explain the apparent disconnect between the real economy and inflation. Empirically, it is not straightforward to gauge the anchoring of inflation expectations. They can be differing interpretations depending on the approach used to define anchoring, as well as the measure and horizon of inflation expectations considered. That said, market-based measures of longer-term inflation expectations have fallen, notably, even when adjusted for various risk premia that can distort the picture. Those measures have also become more responsive to short-term news, which can be interpreted as a sign that the anchoring has softened. Survey-based measures remain more or less within a range which is consistent with the ECB's aim, that is between 1.7% and 1.9%, although they have moved to the lower end of that range since 2019. For the actual process of setting wages and prices, it is the expectations of the public that matter most. Since our last strategy review in 2003, there has been more research on how consumers and firms form their inflation expectations. And while data are still scarce and noisy, the general picture is that consumers hold diverse, very diverse expectations about inflation that appear far less well anchored to our aim than other measures of inflation expectations. In 2015, for instance, average perceived inflation among euro area households was just under 5%, while actual inflation was 0.3%. The generally higher level of household expectations is not necessarily a cause for comfort, though. What emerges from the research in this area is that households take a long time to absorb new information on inflation, but when their expectations do adjust, they can be hard to dislodge. And the direction in which people perceive inflation to be heading can affect their economic decisions. Now, this process, of course, is not exogenous to monetary policy. It is greatly influenced by the central bank's objective and how policy is conducted and communicated in the pursuit of that objective. This is why the discussion of the numerical definition of price stability and on the instruments that can support it over time is so important. And clearly, the three factors that I have just discussed are not mutually exclusive. So it is crucial that we get a much deeper understanding of their relevance and their interactions in order to draw appropriate conclusions for how we conduct our monetary policy. As part of this, we need to understand how they might have interacted with monetary policy approaching the lower bound. And that brings me to my last and final area that I would like to discuss today, which is monetary transmission and effectiveness. As monetary policy everywhere has approached the lower bound, all major central banks have faced questions about their policy space and the traction of their tools on the economy. A key challenge has been the long-term fall in estimates of the natural interest rate. Let me just unpack that a bit. The natural rate is the unobservable interest rate that brings desired saving and investment into balance, or put another way, output close to its potential. Monetary policy is accommodative when the policy rate is below the natural rate, and restrictive when the policy rate is above it. Estimates for the natural rate in the euro area have dropped from anywhere between 0.6% and 2.2% on average from 1999 and 2011 to between minus 1.3% and 0.5% after that. And this has required progressively to lower policy rates in order to ease monetary policy, or even just to prevent that an unchanged policy stance becomes more restrictive. Central banks around the world have shown that this is not a barrier to stabilizing the economy. Before the pandemic, the ECB was able to offset the effect of a declining natural rate by taking its deposit facility rate into negative territory and by deploying forward guidance and asset purchases to ease financing conditions at longer maturities. Indeed, asset purchases, by compressing longer-term bond yields, can induce an easing of financial conditions that can partly compensate for the diminishing scope for conventional policy rate cuts. We also launched a series of targeted longer-term refinancing operations to strengthen the pass-through of these measures via banks to the real economy. And the effects on both financing conditions and the real economy was indeed significant. Considering all the measures taken since mid-2014, the overall impact on euro area real GDP growth is estimated to have anywhere between 2.5 and 3% cumulatively until 2019, and the impact on inflation between 1.7 and 2% cumulatively over the same period. Looking closer to now, the response to the pandemic has provided further evidence of effectiveness. Our Pandemic Emergency Purchase Program, the PEP, and the new series of TLTROs have proven to be powerful tools for stabilizing financing conditions and stimulating credit growth. According to our estimates, the measures we have taken since mid-March this year will increase inflation by around 0.8% cumulatively between 2020 and 2022, and to have increased GDP growth by around 1.3% over the same period of time. However, we have to reflect on what will happen if natural rates remain low and inflation remains subdued, meaning central banks have to continue to resort frequently to balance sheet policies to deliver on their mandates. And this scenario throws up two issues that we need to consider more deeply, and they are the two issues that I want to finally touch on. The first one is what should be the standardized toolkit for a world where unconventional policy is normal policy. The implicit assumption since 2008 has been that policy normalization will mean returning mainly to interest rate policy and winding down unconventional policies. But if normal is closer to what we saw before the outbreak of the pandemic, and I'm afraid what we are seeing even more vividly now, we need to be prepared. We need to have a clear consensus agreed within the Governing Council after good discussions, and need to be understood by the public on what tools are available to us when inflation is too low and how they should be systematically deployed in response to different types of shocks. So we need to further and deepen our understanding of the transmission channels of our different instruments and to evaluate their relative side effects, whether they're intended or unintended, as they work their way through the economy. A central question is the extent to which different tools are substitutes or complements and their potential non-linearities. That is, how their effectiveness might change over time or in different economic conditions. We already have evidence on substitutability. For example, our research finds that without the use of large-scale asset purchases since 2015, our DFR, our deposit facility rate, would have had to fall to around minus 2%, 200 basis points, to achieve the same path of inflation we observed. This is a level that would probably have triggered reversal rate dynamics, a situation where a rate cut becomes contractionary because it harms the business models of financial intermediaries and disrupts monetary policy transmission. Conversely, other instruments have displayed complementarities. Think, for example, of our TLTROs and our negative rate policy. The long-term refinancing operations have been able to leverage the power of the negative rate policy by channeling the stimulative impulse associated with sub-zero rates directly to banks. Unlike in a reversal rate scenario, this promotes credit creation because banks can borrow at very low interest rates under TLTROs under the condition that they lend on without hurting their profitability and impairing monetary transmission. The second and last issue that we need to reflect on is the interactions between monetary and fiscal policies. When central banks have to use balance sheet policies extensively, there is an inevitable strengthening of the interplay between monetary and fiscal policies. And this interaction works both ways. Fiscal policy empowers monetary policy by fostering demand, which brightens economic prospects for firms. This leads them to being encouraged to borrow and allows them to profit from to the full extent from monetary policy stimulus. And monetary policy makes fiscal policy more effective because when monetary policy is at the lower bound and committed to staying there via forward guidance on rates and asset purchases, fiscal multipliers are higher. Indeed, one explanation for the superior inflation performance of the United States relative to that of the euro area in recent times is that monetary and fiscal policies were more aligned in the United States. From 2013 to 2018, fiscal policy in the euro area tightened by around 2.5% of GDP, compared with a loosening of 0.8% in the United States. ECB analysis for the euro area finds that while monetary policy was supporting inflation during this period, it was being largely offset by demand headwinds. The implication is that in the current environment, both policies must remain expansionary for as long as necessary to achieve their respective goals. And in disinflationary conditions, when the economy is running short of its potential, the goal of each policy are naturally aligned. But it seems that there is always a but. If monetary policy and fiscal policy are interacting more closely, it raises important questions. Questions that probably will become even more acute in the aftermath of the pandemic. These includes how to set policy in a world of possibly permanently higher levels of public debt, and what is the appropriate design of Europe's fiscal framework. This is the reason why, since restarting our strategy review, we have introduced a new work stream on monetary/fiscal interactions, precisely to address these questions. So let me conclude. I have tried to lay out some preliminary considerations that are guiding our strategy review. At this stage, as I have said at the outset, it is too early to draw any firm conclusions. So I have rather attempted to identify some of the key issues that the Governing Council will aim to address in the next few months. There is, however, one issue on which I can be decisive today, and I think all members of the Governing Council would agree with me. We must explain much better to the general public what we are doing and why we're doing it. And we must talk to people that we do not normally reach. This imperative has to cascade through all the elements of our review, our inflation aim, our inflation measure, and our tools and their effectiveness, and how we take into account new challenges that people actually care about, their housing cost, but also climate change and inequality. I'm fully committed to that. Monetary policy, in my view, can only be credible if we ensure that our goals are truly understood and shared by the people we serve. As an independent central bank, we are and we will remain accountable to them. I thank you very much for your attention.
That was Christine Lagarde, the president of the European Central Bank, of course, with a very important speech that has lasted about 40 to 45 minutes. The focus, of course, has mainly been on inflation. Now, there are a couple of things that we need to look into, and for that, we have some reaction from Laura Cooper from our MLive team. She did, Madame Lagarde, say that the ECB will consider allowing inflation to overshoot. Laura, good morning to you. I know we were listening to that speech together. Are we any closer to more easing from the ECB?
Well, I think this certainly is the case, that the takeaway is that it was a very dovish commentary from Lagarde today. I think really there's two kind of key takeaways that I'm seeing. One is that, yes, there is this continued willingness to do more, because she did note just the fundamental challenges around this low inflation outlook. And then the second is the fact that they do seem willing to have this inflation targeting regime, average inflation targeting regime, like we're seeing from the Fed, because she did note that such a strategy can actually strengthen the capacity of monetary policy to spur the economy, given the constraint of the zero lower bound. And so it's quite, or negative lower bound, but it's quite interesting because she also noted that inflation expectations are becoming unanchored. So if they were to pursue that strategy, that would be a way of getting those inflation expectations higher. Now, I think ultimately the market reaction is fairly muted at this stage, because clearly inflation is nowhere near their below or 2% target, but it certainly is looking like more easing is in the pipeline after the comments today.
We also heard from the French Banque de France governor actually saying he signaled he's open to letting inflation rise above the ECB's goal. Laura, would that just be putting it in line with what the Fed is trying to do?
Well, that certainly would be the case. I mean, certainly policymakers want to actually see inflation run hot, because that would prevent this decoupling of inflation expectations, which is kind of the key goalpost for central bankers' credibility. But certainly at this point, the fact that we are seeing core inflation prints at record lows across Europe, we are seeing these headline numbers come in negative. And yes, those price trends are being distorted by one-off factors, but clearly just the fact of this degree of slack in the economy and challenging headwinds ahead in terms of virus resurgence, that it's going to be quite difficult for them to actually get anywhere near their current target of below or 2%. So not even kind of even approaching that above 2%. But clearly they want to have that flexibility in terms of their policy guidance, just to anchor these inflation expectations.
Laura, were you expecting a bit more on euro strength or on the currency, or is it just very, very, very delicate for central bankers right now?
I think certainly at this point, what we're seeing in the pair has been one of a dollar story at this stage. Notably, after the U.S. debate, we did see the dollar catch somewhat of a bid. But I think certainly at this point, there's a little upside in terms of positive euro sentiment to play through the euro, because at the same time, we are seeing these reports coming out that the EU Recovery Fund is facing increasing delay, and there's likely to be challenging negotiations ahead, and that's largely priced into the common currency. So those assumptions are going to be challenged, and that really provides limited uplift for the currency unless we see the dollar come under renewed pressure, which, given the current uncertain backdrop, is unlikely to be the case, at least in the near term.
All right, thank you so much, Laura Cooper there from our live team. So to get more analysis on Christine Lagarde's speech at the ECB Watchers Forum, let's get straight to Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management. Karen, great to have you on the program. When you listen to Madame Lagarde actually signaling that they could overshoot inflation to try and get to their goals, what does it actually mean for your portfolio building? Does it change anything? Will they achieve their goal?
Well, I think Laura's summed it up, really. It's all very well saying you would tolerate higher inflation, but of course the key problem for the ECB has even been getting inflation to its close to 2% target. So the key question then for markets is, well, what more are you willing to do? It seems that deeper negative rates is off the table, at least for now. And it's possible they could talk about expanding their asset purchase program. But I think we're at the point now, this isn't just with regards to the ECB, but it's with regards to most of the central banks, where they're a pretty minor act in the outlook now. Their job is to just maintain these low interest rates and support the government. And it's really about whether we're going to see governments using the low interest rates that the central banks are providing them to stimulate the economy. That's going to have then economic implications, that's going to have market implications. But I think the central banks alone, we're at the point of thinking, well, you know, what more can you do to reach these objectives?
Yeah, what more can they do, Karen? If you look at the second phase for central banks, will they have to rely much more on fiscal stimulus? And fiscal stimulus, I guess, is there. Is it all how they deploy it?
I think it's all about fiscal stimulus. And I think fiscal stimulus is a potent and powerful tool. We've seen in the last 6 months, we had the deepest recession we've ever seen, and yet the labour market ramifications, the overall spending ramifications globally were very limited, because essentially governments absorbed that loss, took that loss off of household and corporate balance sheets, and therefore we maintained a decent level of economic activity. So I think fiscal policy is absolutely potent. As you say, there are going to be ways of spending that are going to have more impact than others. I think Europe has a good combination in place, though. Its employment support schemes are doing a very good job of keeping unemployment low, given the macro backdrop. But then I also think they're complementing that with some more long-term vision about spending, particularly with regards to how they want to reach a zero emissions economy. And that's sort of then providing the foundations for how they're going to build back better and stimulate the recovery. So I'd say the shape of the fiscal stimulus in Europe is adequate. We may, over the coming months, find out it just needs to be a bigger quantum.
Karen, when you look at, we had the debate, the first U.S. presidential debate. We have, you know, the ECB. I mean, there's a lot of news out there. What could actually, you know, change the markets, or what could be a catalyst for a correction? Is it the U.S. election? Is it just more volatility to come? How do you see the next 3 months going?
Yeah, I mean, you're absolutely right, Francine. When we look to the final months of the year, we're going to know a lot more by Christmas on multiple fronts. We're going to know whether, after 4.5 years of trying, the UK and the EU can complete a Brexit negotiation. We're going to find out whether there's a medical solution to COVID-19 that can allow us to proceed back towards normality. We're going to find out who the president is of the United States and how that's going to shape relations with the rest of the world. So there's some key events that are going to happen and could potentially lead to some big rotations in markets. And so, you know, what we're really advising clients at the moment is to just focus on balance. You know, it's definitely been, I think, the policy backdrop, the political backdrop has been broadly supportive so far this year. But let's just be a little mindful of some of those risks. It won't necessarily be downside. all of those factors could come into place and create a very strong Q4. But just being balanced so we're not too heavily tilted towards a particular style or a particular region, given just that cocktail of uncertainty we're facing in the final months of the year.
Karen, thank you so much. Karen Ward there from JP Morgan Asset Management stays with us. Now, coming up, we bring you up to speed on all you need to know from last night's contentious presidential debate in Ohio.
Everybody knows he's a liar.
But you
I just want to make sure.
Joe, you're the liar.
I want to make sure.
Graduated last in your class, not first in your class.
I want to make
Mr.
sure.
President, can you let him finish, sir?
No, he doesn't know how to do that. He has,
You'd be surprised.
You pick
You'd be surprised.
the
Go ahead,
wrong
Joe.
guy, the wrong night at the wrong time.
Listen.
Critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
If we would have listened to you, the country would have been left wide open. Millions of people would have died, not 200,000.
Between 750 and 1,000 people today are dying. When he was presented with that number, he said, it is what it is. Well, it is what it is because you are who you are.
Many of your Democrat governors said, President Trump did a phenomenal job. We got the gowns, we got the masks, we made the ventilators. You wouldn't have made ventilators, and now we're weeks away from a vaccine.
You should get out of your bunker and get out of the sand trap and get in your golf course and go in the Oval Office and bring together the Democrats and Republicans and fund what needs to be done now to save lives.
You could never have done the job that we did. You don't have it in your blood. You could have never done that job. We're going to deliver it right away. We have our military that delivers soldiers, and they can do 200,000 a day. They're going to be delivering.
This is the same man who told you by Easter this would be gone away. By the warm weather it'd be gone. Miraculous, like a miracle. And by the way, maybe you could inject some bleach in your arm and that would take care of it.
Some highlights there of the first presidential debate. But what does it all mean for the markets? Well, still with us is Karen Ward, the MEA Chief Market Strategist at JP Morgan Asset Management. Karen, what's, for the markets, I guess, they like certainty. I don't know whether there's something priced in at the moment or they're still waiting for the polls and the markets will decide which candidate really has a better chance closer to November 3rd.
I think there's a healthy degree of skepticism about the polls, not only the night before, but certainly as many weeks out as we are, a lot can change. So I think I wouldn't say there is a high conviction direction for how this election is going to play out. In terms of last night's debate, I think, perhaps what would have been comforting would to hear about, infrastructure plans, policies, spending plans post the election, but clearly that's not what we ended up with. It was a much more sort of personal discussion, and the only thing the market really got is this idea of a contested election, and therefore, as you say, that sort of ongoing uncertainty, which is something that's very hard for investors to deal with.
So, Karen, if President Trump has a second term, what do you buy into? I mean, what's the perfect positioning to face like 4 years of a Trump administration?
I think the only thing you could probably say, at least the initial market reaction, would be that the market would probably think, well, that's good for domestic US, it may not be good for the rest of the world. Now, I think that will be the initial market reaction. I actually think that will be quite an opportunity for investors, because we've been here before. Trade wars are much easier to talk about than they are to implement. The economic ramifications for the US of trying to cut out China or deteriorate relations with the rest of the world, it comes back to bite at home. So I think that will be a very initial reaction. Were we to see a Trump second term, would be that relative story, the US versus the rest of the world. But as I say, I don't think that would be necessarily a lasting trend, because I think it's a common narrative and we've been there before.
So would European equities also move on the back of a second term for President Trump, because we could expect extra tariffs, for example, on German car makers?
Whether it's targeted action at the EU particularly, or just how the EU is interlinked with China and broader emerging economies. I mean, Europe has done a very good job of reorientating its economy towards the emerging world and towards China, and many of its exports orientated in that direction. So I think Europe thrives, and Europe's asset markets thrive when we're talking about synchronized global recovery. So if it were the case that the market started to question that synchronized global story, or if we were looking at a more hostile trade, then I think that's when European markets could suffer in that environment. But I don't necessarily think that's a given. I mean, it may not be a priority for President Trump if he did get his second term. He has, as I say, tried trade hostilities before. It didn't play out in terms of how it affected his domestic economy and his domestic stock market. So maybe that won't be a priority in the second term, particularly if he actually sweeps and gets control of both houses, and therefore he's got more options with regards to domestic policies. So, I think it's very difficult to say anything with much certainty about either of the candidates or what they're going to mean for markets. It's going to be very choppy. It's going to be a lot of learning on the day and just seeing what happens.
Karen, thanks so much. Karen Ward there from JP Morgan Asset Management. She stays with us. Now, coming up, the future of U.S.-EU relations, our interview with the U.S. Undersecretary for Economic Growth. He's Keith Crack. That's later on this hour, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Thanks, Francine. Shell is cutting up to 9,000 jobs as coronavirus accelerates a company-wide restructuring. The reductions are expected by the end of 2022, and the aim is to make an annual cost saving of $2 to $2.5 billion. CEO Ben van Beurden says he wants to build a simpler, more streamlined and more competitive organization. Disney is slashing 28,000 jobs in its slumping U.S. resort business. It's one of the deepest cuts of the COVID-19 era. The move affects the company's theme park, cruise line and retail businesses, 67% of those being terminated as part-time workers. Some Disney parks are now open, but it still hasn't got clearance to restart operations at its flagship resorts in California. And that's your Bloomberg Business Flash. Francine.
Laura, thank you so much. Now let's focus on the UK, and Boris Johnson is braced for defeat in Parliament over his controversial plan to rewrite the Brexit withdrawal agreement. Meanwhile, the UK Prime Minister has been warned by Conservative lawmakers that he also faces a rebellion on his COVID regulations today if he fails to give Parliament more scrutiny powers. Well, still with us is Karen Ward from JP Morgan Asset Management. Karen, how do you deal with UK assets right now? So, we have all this uncertainty with a growing rebellion within the Conservative Party, and then we face, of course, a Brexit deadline.
Yes, exactly. It's almost a perfect storm, I think, in terms of the UK's outlook at the moment. I would say our core assumption is still that a Brexit deal does get done. Now, the deal itself is looking increasingly narrow, so it's still going to be disruptive. But my core assumption is that compromises are made on both sides, certainly for key sectors, strategic industries that really need to maintain that flow of trade, and therefore there is agreement on regulatory alignment in those key sectors. But then I also think both sides will agree to transitional arrangements just to ease the burden of that day one change for all those companies that will be affected, because let's face it, there's a lot going on for businesses right now. So I'm assuming a very pragmatic approach as we near these final months, and some compromises to be made on both sides. Now, I could be wrong. I think it's easier to think about the ramifications for sterling than it is necessarily for the UK stock market. I think, if we were to see a narrow deal go through, we think we could see upside maybe in the region of 6 to 7% for sterling against its major counterparts. On the downside, we think that if we were to see no deal and it was a more disruptive outcome at year end, we'd probably see about 10% off of sterling. How that translates into the FTSE is a little bit more tricky. I think it really depends on the extent to which the market perceives this to be a global event, and it's going to damage global confidence and global sentiment, because, of course, 3/4 of FTSE 100 revenues come from outside of the UK. So if the rest of the world is unaffected and it ends up being a UK problem, then the FTSE could actually do quite well from a decline in sterling. But if it ends up being a more global, it's going to have a broader impact on Europe, a broader impact on global confidence, then I think that's not necessarily assured. So it's another, element of uncertainty in Q4.
Karen, very quickly, if there is a no-deal Brexit, is it automatically inflationary?
I would say for the UK, I think it is. It will be quite a significant supply shock. The sourcing issues, if it's disruptive and there are not transitional measures that are put in place, I do think the decline in sterling, the rise in import costs, the supply pressures will mean that we do see inflationary pressures, at least in the short term. And then the only question really is the degree to which demand suffers at home, which stops those price increases filtering through into something more sustained. But at least initially, I would think so.
Karen, thank you so much for today. Karen Ward there, EMEA Chief Market Strategist at JP Morgan Asset Management. Now, coming up, we bring you up to speed on all you need to know from last night's contentious presidential debate in Ohio. Much more with us shortly. This is Bloomberg. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Chaos in Cleveland. President Trump and Joe Biden's first debate was a contentious 90 minutes as the candidates clashed on everything from COVID to climate change. Trump's confrontational style risks repelling key voters. Europe's shaky recovery. Germany is set to rein in public and private parties. Its inflation rate falls further below zero, adding to the case that the ECB may need to do more. Christine Lagarde says we need to analyze inflation dynamics. And the pandemic jobs crisis continues. Disney announces 28,000 layoffs. Shell will shed up to 9,000 jobs as the crisis takes its tolls. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the market's partly looking, of course, at what we heard from Christine Lagarde and partly looking at what we also heard in that debate overnight. Now, this is the picture overall. If you look at some of the European stocks, they're definitely under a bit more pressure after the debate. The gauge of the dollar is actually holding steady, and it was a pretty acrimonious American presidential debate, and it just seems to highlight the risk of a contested vote in November. Now, let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Thanks, Francine. Well, aviation looking interesting this morning. A key milestone in the long-running Boeing-Airbus dispute. Sources telling Bloomberg the World Trade Organization is awarding the EU $4 billion in sanctions it can impose on U.S. exports. That's in retaliation for government aid to Boeing. But it is lower than the award the WTO granted the U.S. last year over Airbus. An antibody cocktail from Regeneron may help reduce virus levels and symptoms. That's according to early results from a trial. The company says the greatest benefit was in patients who had not mounted their own effective immune response. It's a sign that experimental antibody treatments could become a powerful tool in the fight against coronavirus. In the UK, Prime Minister Boris Johnson is bracing for defeat in Parliament. His plan to rewrite the Brexit withdrawal agreement passed its final hurdle in the Commons, but it's now set for the Lords, where the Conservative Party does not have a majority. Rebels are also warning the Prime Minister faces defeat over coronavirus rules if he does not give Parliament more power to scrutinise them. Speaker Nancy Pelosi is moving closer to a House vote on a Democrats-only stimulus plan. Talks with Treasury Secretary Steven Mnuchin are continuing, but still seem to be at a stalemate. If the deadlock cannot be broken, the House may vote on the $2.2 trillion plan this week. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now, last night was the first presidential debate. It slipped into chaos as President Trump and nominee Joe Biden hurled insults and repeatedly interrupted each other as they sparred over topics ranging from the economy and race to Trump's taxes and COVID.
Everybody knows he's a liar.
But you
I just want to make sure.
Joe, you're the liar.
I want to make sure.
Graduated last in your class, not first in your class.
I want to make
Mr.
sure.
Mr. President, can you let him finish, sir?
No, he doesn't know how to do that. He knew it was a deadly disease. What did he do? He's on tape as acknowledging he knew it. He said he didn't tell us or give people a warning of it because he didn't want to panic the American people. You don't panic. He panicked.
We've done a great job. The only thing I haven't done a good job, and that's because of the fake news. No matter what you say to them, they give you bad press on it. It's just fake news. They had the slowest recovery since economic recovery since 1929. It was the slowest recovery. I paid $38 million 1 year. I paid $27 million.
Show us your tax returns. Nobody's doing that. He's the racist.
You just don't.
Here's the deal. I know a lot more about this.
Let him finish.
The fact is that there is racial insensitivity. People have to be made aware of what other people feel like.
Now, for more on the debate, let's go to Bloomberg's Kayleigh Lyons. He's been following all of the action from New York. Kayleigh, thank you so much for joining us. There's a lot of chatter about how heated the debate was. How will it play out in the polls?
That's the key question tonight, Francine. This was a very messy, undignified debate. The candidates speaking over each other repeatedly. Biden at one point telling President Trump to, quote, shut up. He called him a clown. He called him a racist. He called him the worst president America has ever had, while Trump, for his part, attacking Biden on his intelligence and on allegations surrounding his son, Hunter Biden. So at the end of the day, this was really just a lot of noise, not a lot of actual policy conversation, which may have been what many voters and certainly the moderator, Chris Wallace, were actually looking for, and that just didn't happen tonight, Francine.
Kayleigh, on the specific policy, did we actually get any details? What were some of the primary messages?
Well, they did have 6 discussion topics they spoke to, from the Supreme Court to the virus to inequality to issues around election security. Largely, we just heard from the candidates things they've already said, really sticking to their talking points. Biden coming after President Trump on his handling of the coronavirus pandemic and the economic recession that it has caused. He did talk about his healthcare and economic and tax plans, but by and large, it was a lot that he didn't get out complete thoughts due to President Trump interrupting him. And President Trump, for his part, largely on the defensive when it came to his record in regard to responding to the coronavirus, as well as talking about the strength of the economy before the pandemic. But one of the really most talked about points in the debate was on the issue of racial inequality and white supremacy. Take a listen to what the president had to say when asked if he would condemn white supremacists.
Almost everything I see is from the left wing, not from the right wing.
So what are you saying?
I'm willing to do anything. I want to see peace.
Then do it, sir.
Say it. Do it. Say it.
Do you want to call him? What do you want to call him? Give me a name. Give me a
white
name.
Supremacists
Who would you like me to condemn?
White supremacists and right
Proud Boys. Stand back and stand by. But I'll tell you what. Somebody's got to do something about Antifa and the left.
So you heard him there, not condemning white supremacists, saying instead, stand up, stand by. Something else we didn't hear from the president tonight, Francine, was a commitment to tell his supporters to react calmly should there be any kind of delay when it comes to the election results. And once again, he cast doubt on mail-in voting and its legitimacy, and that is creating a lot of conversation now post-debate about whether or not this is going to end up as a contested election, Francine.
Kayleigh, did the candidates do what they needed tonight? Are we going to have immediate polls to try and see who won, or does it just get shifted to the next debate?
Well, we did see some polling pretty immediately out of CBS News. They found that 69% of voters who watched the debate said they were annoyed afterwards, and 42% of voters said they had a worse opinion of President Trump afterwards. So that is something we have to keep in mind, is that the president really needs to try and win over suburban voters, women specifically, and many are saying that his aggressive tactics tonight may have pushed them away. We have to remember that Biden leading in national and key swing state polls going into this debate, Trump the most behind of any incumbent president since the 90s, and it's unclear if he did anything tonight that is going to close that gap and revitalize his campaign, Francine.
Okay, thanks so much for the update. Great reporting there overnight from our Kayleigh Lyons in New York. Now, coming up, Disney is cutting 28,000 jobs in one of the biggest layoffs of the COVID-19 era. We'll discuss that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, we heard from Mr. Haldane of the Bank of England actually expressing himself on negative rates. He says that the work on negative rates is likely to take months. Of course, one of the most interesting debates in terms of central banks is whether the Bank of England will go into negative territory. We spoke to the Governor, Andrew Bailey, at length, and he had suggested also at some point is that timing is crucial on when to go into negative rates. Now, he didn't say that this was, something that they were looking to do, but he said, it's part of the toolbox. At that point, he didn't want to rule anything out. But there was an assumption in the markets that you would go into negative rates during a downturn. He seemed to suggest at some point that actually, you could also see negative rates in a cycle because that would really support the recovery. I mean, a million questions regarding the UK, given it's also linked to Brexit. The Bank of England, according to Mr. Haldane, chief economist, sees GDP of 3 to 4% below pre-COVID level at the end of the third quarter. So we'll have plenty more on that. You can see sterling 128.34. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Thanks, Francine. Starting with Wall Street, JP Morgan has admitted wrongdoing and agreed to pay more than $920 million over spoofing claims. It's the largest sanction ever tied to the practice and involved 15 traders over 2 of the bank's desks. The Justice Department is deferring prosecution on 2 cases of wire fraud. As part of the deal, JP Morgan will report its compliance efforts to the government. Micron shares are down after the largest US chipmaker said it's halting shipments to Huawei. That's after recent US government action designed to cut the Chinese tech giant off from its suppliers. Micron also cut its capital spending plans, warning of weaker demand and possible oversupply in the market. Wall Street banks complaining about trading venues charging high prices for data have a new ally. Donald Trump's chief competition watchdog, the Justice Department's antitrust division, says it's paying close attention, adding it will pursue any anti-competitive conduct on Wall Street. By the way, Bloomberg News' parent company is among the firms that have contested fee increases for data. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Laura. Now, from big oil to the entertainment giants, corporates continue to slash jobs at a breakneck pace. Disney's announcements includes a 28,000 reduction, one of the biggest layoffs of the COVID era. Well, joining us now to discuss all of this is Danny Berger. Danny, first of all, good morning. But just how surprising is it, Disney's decision to cut nearly 30,000 jobs? It's people that work in their theme parks.
Exactly. And Francine, look, it's not surprising that Disney has had to reduce costs. Clearly, theme parks have been struggling with many closures around the world, but it's the severity of these cuts that has surprised investors. And we saw that reaction in the share price, at one point dropping as much as 2% in aftermarket trading. And this really signals that not only was Disney hit by the initial COVID crisis, it's taking a while for it to recover. Not only is this bad news for Disney, but really for the labor market as a whole, as we continue to get these announcements of job cuts. Now, again, a lot of Disney's theme parks are closed around the world. This reflects many businesses. And for the ones that are open, it's a very limited capacity. So Disney, for its part, slashing jobs among executives, among salary employees, but majority, I should say, are coming from those who are working part-time.
Shell also announced an overhaul this morning. How many jobs can we, expect them to slash, Danny?
So according to Shell, by 2022, they'll have cut between 7,000 and 9,000 jobs. Again, this is another announcement that just shows us how much big oil continues to struggle. We've seen dividends slash. We've had big impairment charges. Shell says that really the crisis has sped up their conversion to a lower carbon energy company, and that's why they've decided to undertake this restructuring. The CEO saying we have to be a simpler, more streamlined, more competitive organization, and in many places we have too many layers in the company. Now, at the same time, Shell also warning of lower third quarter sales. So it's really key for them to cut costs at this moment. They think they could save as much as $2.5 billion annually by making these job cuts, Francine.
Thank you so much, Danny Berger, there with the very latest, of course, on some of these job losses. Now, coming up, the future of the U.S. and EU relations. Don't miss our interview with the U.S. Undersecretary for Economic Growth. He's Keith Crack. That's coming up next, and this is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
I paid millions of dollars in taxes, millions of dollars of income tax. And let me just tell you, there was a story in one of the papers. I paid $38 million one year. I paid $27 million.
Show us your tax returns.
He passed a tax bill that gave us all these privileges for depreciation and for tax credits. We build the building and we get tax credits like the hotel on Pennsylvania Avenue. You get a massive, which, by the way, was given to me by the Obama administration, if you can believe that.
The tax code that made him, put him in a position that he pays less tax than a school teacher on the money a school teacher makes is because of him he says he's smart because he can take advantage of the tax code. And he does take advantage of the tax code. That's why I'm going to eliminate the Trump tax cuts. And I'm going to eliminate those tax cuts and make sure that we invest in the people who, in fact, need the help.
Donald Trump and Joe Biden, they're talking taxes at yesterday's debate. Now let's focus on the future of U.S.-EU relations. Our next guest is visiting Brussels for meetings with NATO, the EU, and Belgian government officials. Now, top of the agenda, security issues, especially around Huawei and the building of 5G mobile networks. Let's go live straight to Brussels and our reporter, Maria Tadeo, who's standing by with a special guest. Hi, Maria.
Well, Francine, thanks so much. And we do have a very special guest today in Brussels. He is Keith Krog, the Undersecretary of State for the U.S. He focuses on economic growth, energy, and the environment. We're so happy you're here because you were telling me about this European tour that you've been doing for a week. But before we head into that, I do have to ask you about the situation going on with TikTok, because there's a lot of confusion in the market as to what's going to happen now that the court has jumped in, what's going to happen to the terms of the future deal. What can you tell us about it, and what is the administration going to do in the future weeks?
Well, Maria, thanks for having me back on Bloomberg. It's great to be here in Brussels. You know, on TikTok, it's more than about one company. It's more than about a TikTok and a WeChat. What it's really about is the CCP's threat, the Chinese Communist Party's threat to democracy and their surveillance state. So if you look at what they are doing, they're extending that great one-way China firewall where all the data comes in, but none comes out. And reciprocally, all the propaganda goes out, but the truth does not come in. And so TikTok just happens to be an app like WeChat that collects massive amounts of data that goes into their AI machine so they can come up with that one number. And that one number is a social credit score in China. It's for every person, every company. And that one number defines how loyal you are to the Chinese Communist Party. Now, they can do that in Brussels. They can do that in the U.S. They can do it anywhere in the world. And it's like, how loyal? It's not really how loyal they are, but how easy will it be to get to ally with the Chinese Communist Party or turn them. So that's really what it's about. And the President's been very clear about this in terms of protecting American security on that. And that's really what the Clean Network's all about.
And but when you look at what is happening with the court, and they say you may have overstepped some of the authority there, your views are very clear. I mean, you're saying right now China is a national threat, and you don't trust any of these apps. Do you think the court is then making a mistake, and are you going to win this case?
Well, you know, I don't know, but all I know is that it's great that we have three branches of government, have checks and power, so we don't end up with a lifelong dictator like President Xi.
What do you respond to the Chinese when they say what the U.S. is doing is just extortion?
Well, I would say, well, look at your market. And by the way, you can't even use your Twitter that you use all around the world. Your ambassadors use all around the world. You don't let Google in. You don't let Facebook in. I mean, I just say you're the biggest hypocrites in the world.
And I do have to ask you, because you know the tech world very well. Do you worry, however, that, you know, if you're an American company, you're a supplier perhaps to Huawei, you're not allowed to work with Huawei anymore? Do you worry that ultimately these restrictions are detrimental to U.S. companies, or could be in the future? They're losing a big client.
You know what's interesting? So I took Secretary Pompeo out I hosted him in Silicon Valley at the beginning of the year. We kicked it off with a dinner at my house. We had 36 of the top CEOs. We had them all go around the room, tell your favorite China story. And I can tell you, it's the same as when I have my bilaterals with different governments. They'll literally look around and they'll say, we don't trust them. And nobody trusts them. And one of the things that I've said, that I actually said that night, is I said, the Chinese Communist Party is a real and urgent threat to democracy around the world. It's also a real and urgent threat to your businesses, because they don't just want to compete. They want to put you out of business. And in Silicon Valley, we say corporate responsibility is social responsibility. We also now say, you know, it's also global economic security. So what we've seen now, over the last 6 months, since the pandemic, citizens of the world have woken up to the truth about China's, I call it their 3 C's doctrine: concealment, co-option, and coercion. These citizens understand that the pandemic is a result of the concealment of the virus. And they understand that the invasion of Hong Kong has eviscerated their freedoms. And they also understand that the coercion in Xinjiang has created some of the most crazy human rights abuses in a long, long time.
And that's definitely a topic here in Europe. But I'm wondering, I know you went to Germany. I know you went to 3 different cities in Germany. What are the Germans telling you about Huawei and 5G? Because they still have to roll out big contracts there. Did they tell you we're not going to work with Huawei?
Well, by the way, they are, first of all, we respect Germany's right to make a decision. And, you know, it comes down to German law, German basic law, which is their Constitution, Article 1. And that says 2 words: human dignity, and they totally get it. So I'm very...
So they told you, no, we're not going to work with Huawei? They said that?
Well, by the way, they totally agree with us on the North Star. And I had great meetings with many of the CEOs, with their governments. They're writing that IT security act. We talked with them about paragraph 109 and 9B. Because what they're really doing is they're creating a digital trust standard that leverages off the things we're doing in the clean network, and also EU's 5G clean toolbox.
And just a very brief answer here, because, you know, we're running out of time, but I do want to put the question, what about the Nord Stream pipe? Did you talk with the Germans about this? Because the U.S. has said if you go ahead with this, there could be sanctions.
I think they understand our position is very clear, and it's aligned with this same position as the EU. We see this as a tool for Russia, so we see it as a threat to European security.
Well, Undersecretary, thank you so much for joining us here on Bloomberg. It was very great to see you.
Great.
Francine, well, you heard it right there. He thinks there's very good meetings happening with Germans, and the Germans are not going to work with Huawei. We'll have to wait what Angela Merkel says.
Maria, thank you so much. Maria Tadeo there with that really engaging interview talking about a number of things, including Huawei. This is what the markets are doing. So European markets are down. A lot of the focus, of course, is on the U.S. presidential debate that we saw last night. It's the first one. It was pretty acrimonious, and there does seem to be a bit of a feeling in the markets that it could be too close to call, which makes people a bit nervous. What else I'm looking at is, so the dollar's pretty much steady with treasuries. WTI, though, oil over in the U.S. hovering near $39 a barrel. I'm also looking at a couple of other things, including a pound, which for the moment is not really moving that much, although we did hear from Handy Aldane on negative rates. Bloomberg surveillance continues, of course, as always, as every day, every weekday. It continues in the next hour. Tom Keene joins me out of New York. Don't miss our conversation with Thomas Barking of the Richmond Fed. This is Bloomberg. another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television. Chaos in Cleveland. President Trump and Joe Biden's first debate was a contentious 90 minutes as the candidates clashed on everything from COVID to climate change. The acrimony highlighted the risk of a contested vote in November. Europe's shaky recovery, the inflation rate falls further below zero, adding to the case that the ECB may consider allowing inflation to overshoot. Christine Lagarde says it's not about moving the goalposts for monetary policy. And the pandemic jobs crisis continues. Disney announces 28,000 layoffs, and Shell will shed up to 9,000 jobs as the crisis takes its toll. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, a lot of the cues, actually, in terms of news flow today will be from the markets. So we have a lot of big news flows, a lot of jobs being lost because of COVID, and, of course, a recession that could take place. A lot of focus on the U.S. presidential debate. I mean, at some points, it was just nasty from both sides. And I guess the market is trying to figure out what that means.
Francine, did you stay up and watch this?
I went to sleep and then put the alarm clock to wake up. It's a little bit messed up. If I can't talk today, Tom, it's because the timing is not matched for European viewers.
Absolutely extraordinary. You know, this is not the place to editorialize about this and bring the show to a screeching halt, but for our international audience to be kind, it was absolutely original. What my goal is today, Francine, across the hours of surveillance, is to spin forward. Do you realize we're going to do this on October 15th? In Miami with the great Steve Scully of C-SPAN in a town hall format. I can't get my head around that, but that's what we'll do here with Bloomberg Politics with David Weston and Kevin Cirilli, try to recoup and prepare for the Ides of October.
It's all right. We have 16 days to recoup, Tom.
Yes.
The focus, of course, is on the polls, right? So we had initial polls, but it'll be interesting over the next 24 hours.
Oh, you're such a political tweet. You know, polls.
Leslie Vinjamurian. Polls, but
Leslie was out tweeting last night at 4 a.m. I think she was in a pub with Pharaoh. You know, I don't know what she was doing.
The pubs close at 10 p.m., Tom. But yes, she's been on top of the news, so we'll get to Leslie shortly. Now let's get straight to the Bloomberg. First word news in New York City. Here's Radhika Gupta. Hi, Radhika.
Hi, Francine. Tom, it was billed as the first presidential debate, but last night's event in Cleveland quickly slipped into chaos, and insults drowned out ideas. At one point, President Trump and Joe Biden battled over the coronavirus.
He knew it was a deadly disease. What did he do? He's on tape as acknowledging he knew it. He said he didn't tell us or give people a warning of it because he didn't want to panic the American people. You don't panic. He panicked.
We've done a great job. The only thing I haven't done a good job, and that's because of the fake news. No matter what you say to them, they give you bad press on it. It's just fake news. They give you good press, they give me bad press, because that's the way it is, unfortunately. But let me just tell you something. I don't care. I've gotten used to it. But I'll tell you, Joe, you could never have done the job that we did. You don't have it in your blood. You could have never done that job.
I know how to do the job. I know how to get the job
Well, you
done.
didn't do very well in swine flu.
Moderator Chris Wallace kept trying, mostly in vain, to control the conversation. House Speaker Nancy Pelosi is moving lawmakers closer to a vote on a Democrats-only stimulus plan. The $2.2 trillion measure is aimed at breaking the deadlock in talks with the Trump administration. Pelosi and Treasury Secretary Steven Mnuchin are still trying to come up with a compromise deal. And Senate Democrats want Supreme Court nominee Amy Coney Barrett to promise to recuse herself from cases related to the 2020 election. That's after President Trump said the court might decide the outcome, and he expects her to break a tie. Supreme Court justices decide themselves whether to step away from a case. In the UK, Prime Minister Boris Johnson will try to regain control of his coronavirus strategy. His own Conservative colleagues have warned him that he faces a damaging defeat on COVID regulations today, unless he gives Parliament more authority to scrutinise the powers. Johnson also had to apologise for wrongly explaining the government's new pandemic restrictions. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
All right, Ritika, thanks so much. We switch to the jobs. We got the claims tomorrow, jobs day on Friday. Really interesting. Francine, of course, mentioning very challenging layoffs at Disney. I'll wait to the tape, negative 27. Dow futures, negative 236. The VIX, 26.86. The real yield, Francine, this is important. Bonds are dead, but the real yield, and we'll explain this through the hours today, has come back down to a greater negative statistic. It was a -1, negative 0.9952. To me, Francine, that's a huge deal. I do want to point out, Francine, the 2-year Govy is to 0.1211, and that is ground down on 4 digits to a new lower 2-year yield.
Yeah, Tom, I think we need to spend a bit more time actually looking at fixed income, especially here in Europe. I regret not putting in my data check, but there's a couple of things going on, given that Christine Lagarde now says that she could look a bit more to what the Fed is doing and let inflation overshoot to make sure that she achieves that target. Now, global investors, of course, keeping an eye on the vaccine, coronavirus. We're getting some updates there on talks in Washington for new stimulus, but really it was all about the debate, and there does seem to be a bit of an uneasy feeling, or at least the fact that the debate highlighted the risk of a contested vote in November. You can see futures down, European stocks are down some 0.2%. So last night, the first presidential debate, it slipped into chaos as President Trump and nominee Joe Biden hurled insults and repeatedly interrupted each other. They sparred over topics ranging from the virus and President Trump's taxes to China and the economy.
Chrysler and General Motors, we brought them back right here in the state of Ohio and Michigan. He blew it. They're gone. He blew it. And in fact, they're going.
Ohio had the best year it's ever had last year. Michigan had the best year they've ever had.
That is not
Many
true.
car companies came in from Germany, from Japan, went to Michigan, went to Ohio.
They're not having that.
And they didn't come in with you.
Mr. Vice President, go ahead.
And so you take a look at what he's actually done. He's done very little. His trade deals are the same way. He talks about these great trade deals. You know, he talks about the art of the deal. China's perfected the art of the steal. We have a higher deficit with China now than we did before. We have the highest trade deficit
China
with
ate
Mexico.
your lunch, down 18%. China ate your lunch, Joe.
Well, joining us now is Leslie Vinjamuri, Chatham House U.S. and the Americas Program Director. Leslie, thank you for joining us. Do we care about who won or who didn't win the debate? Does it actually move the polls, or was it just very difficult because it was bickering?
Well, it was a really tough debate to watch. I imagine, and we'll wait and see, that a lot of people will have turned the television off pretty quickly. The speakers were talking over each other, but they did cover a number of topics. They didn't see anything through. But remember, Francine, that 90%, more than 90% of voters already have made up their mind. And so it's surprising how widely viewed the debate was, given that fact. I think the real goal of the debate was to see, how enthusiastic voters might be at the end of it to ensure that they actually turn out and vote. And this is especially an issue for Vice President Biden, where, we've seen in the polling that younger voters support him, but they're not all that enthusiastic. So one question is, how did they come out of this? I think probably very frustrated. They saw a president who really did, as you said, stoke fear over the legitimacy of mail-in balloting. Ballots, questioned the integrity of the elections, really left us, after last week where he refused to say that he would accept the results of the election, he really, stoked that fear once again. And on the back of that very long segment where he talked about the problems of violence, the lack of law and order in Democratic-run cities. So I think there's a real effort, I think, to stoke fear. Difficult to say what that does in terms of public opinion, but again, most people know where they stand. And then the other thing I would add is, Vice President Biden, his I think the moment when he became most passionate was partly in his discussion about healthcare. He managed to move that conversation about the Supreme Court, which really plays to the president's favor with his base. He moved it to a discussion of healthcare and the pandemic very quickly. And he was very passionate when he talked about his plans for climate change. And of course, this is the area where the two candidates differ most sharply among the topics that were discussed last night.
So, Leslie, how will each side actually, speak to their candidates to change the performance in the next debate?
Well, I mean, I've got to believe that, that President Trump's advisors will caution him to listen, to wait, to hold back. Remember, he had, Chris Wallace, he had somebody who should be, slightly more, far more helpful to him. That's not going to be the case in all the debates. I think a lot of people left last night wondering if there would be another debate because it was frankly so awful. But I think that the caution will be, be careful in your nod to white supremacists. I mean, this is a truly awful moment in the debate. Be cautious of how far you push this question, these allegations of fraud. Difficult to know, where the advice is on that. But I think it's a really serious question. But I think, that the caution to both candidates will be try as you can to listen. Although I suspect Vice President Biden, there probably is some advice to talk over because, if you don't talk over President Trump, it's not clear that you get a word in edgewise. So I suspect that some of that is very concrete advice to Vice President Biden.
Leslie, thank you for pulling an all-nighter for us. I mean, it's just great to have you here. It's just like college. Leslie, I really want to push forward to Miami in a town hall meeting, and I think there'll be a lot of punditry on this and what we'll see from Vice President Biden with the polling, et cetera, where Biden maybe could take Florida. Is the president coachable? Is the president advisable by his professional political team or directly by his family?
This requires a level of expertise that I'm not sure any of us have. But I believe, right? We have all been watching him very carefully for the past 4 years longer. And I believe that you can see those moments where in his mind, he is hearing the advice of the people around him, where you can see him flustered and frustrated and where he's holding back. The problem is, it's that impulse control. It's that thing that we all teach our children, we all work at throughout our lives and our careers, and that impulse control.
Leslie, I don't mean to interrupt, Leslie, but this is so important. Was that the same Donald Trump that we saw on stage in the first debate with Secretary Clinton 4 years ago? Or is he so changed with the pressures of the office and Mr. Woodward's word rage that what we saw last night has nothing to do with the president polish of 4 years ago?
Yeah, I mean, I think the issue here is that this is a president who's on the back foot. He's at least 7% down in the polls. He knows that this is a tough election. He is losing on the issues that he cares most about, the economy. He's losing on the pandemic. He got hit by a crisis. This, for him, it didn't come out of left field. He'd like us to believe that it did. And so he is on the attack. He's on the defense. And he shouldn't be, right? He's the incumbent president. He should be sailing forward on this, and he knows he's not. And so I think you're right. He is clearly got a lot of rage and struggling to contain it. And again, it's going to be really interesting to see what happens over the course of the next two debates, should they take place. I assume that they will, but it's not dead obvious.
Leslie, thank you so much for all of the insight. Leslie Vinjamuri, there, Chatham House U.S. and the Americas Program Director. Now, coming up next, we speak with Rick Lakai. He's State Street Global Advisors Global Chief Investment Officer. We'll talk to him how to play the U.S. elections. We'll also talk to him about Brexit and negative rates. This is Bloomberg.
don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
It is not about moving the goalpost for monetary policy where it is suitable. It is about future-proofing how we measure inflation. But we also need to recognize that adjustments will have issues in terms of reliability and frequency of data.
Well, that was the ECB President, Christine Lagarde, speaking earlier at the ECB and its Watchers event in Frankfurt. Joining us now to talk about the markets is Rick Lacaille, State Street Global Advisors Global Chief Investment Officer. Rick, as always, thank you for joining Surveillance. I'm not sure whether I should, start by asking you about the ECB and this possible change to inflation goals with Christine Lagarde ready to overshoot it, a bit to make sure that she hits it, or whether actually it's all about U.S. politics and whether that could really change the direction of the markets.
Well, I think the last time we spoke, it was just after the Fed announced they were having an averaging policy, and the question was, would that spread elsewhere? I think the overshooting language isn't quite the same, but I do think the concept is similar, that we need to look at a variety of frequency of data and kind of think about what's a sustainable policy. And if you take that coupled with ECB allowing collateral for sustainable bond issues, the kind of contours of a Lagarde ECB are now becoming a little clearer, and I think quite positive for investors.
So does it mean that we'll have more QE? This was a very dovish speech from Christine Lagarde this morning.
Yeah, I mean, I think there is a read across from that to QE or expectations of QE policy, but I think clearly that'll depend on a number of factors. But I think you've got a very supportive ECB, a very concerned ECB about how the chronic phase of the pandemic is emerging. And what else can be done? But they've done a lot on credit already, but I guess they're going to do more given the lack of concern about inflation.
Rick, we are distracted by the silliness of the political season. What I observe in break-evens across the Western world and Japan, what I see in the 10-year and 2-year German dynamics is whiffs of disinflation and deflation. Is that trend now entrenched, and do we have to adapt to it in our investment?
Well, we've had that adaptation for a long time, and I think you pointed out just earlier, that we've got real yields at extraordinarily low levels, negative interest rates, negative real yields. And really, that's forcing investors to think about where they're going to get returns from. It's not a willy-nilly dash for spread assets, but certainly we're being squeezed into those that are available. And there are some good ones that are available. If you look at even Chinese government bonds, Mexican government bonds in local currency, if you think those currencies are not overvalued, there's opportunities. And even close to home in Europe, European high yield, I think having gone through a number of phases, is now emerging as an investable asset class for many fixed income investors.
Is there original risk on European high yield, or can you easily diversify the risk away?
You can diversify more than you used to be able to. I mean, if you go back 5 or 10, European high yield was a very immature market. There are more issues, more sectors now. Now, they're the sectors that look like value to some extent. You've got industrials, you've got some of the things that haven't been working well in the equity market, but straight answer to the question, you can diversify, but you wouldn't want to put all your eggs in that European high yield basket.
Rick, depending on who gets into the White House, what does it mean for European equities? I know Germany has certainly braced for extra tariffs from the Trump administration for quite some time. Would they come in a second term?
Yeah, well, Europe could still be playing catch up. It's had a reasonably good controllable chronic phase of the pandemic. I think China is awfully, incredibly helpful for Europe, and Chinese data continues to get somewhat better. In terms of the Trump or Biden presidency, you may have a strong swing towards green and sustainable policies, and that may be helpful for Europe, or at least certain parts of industrial Europe, to export into the US. But I think the Trump presidency also brings with it, this potential for a little bit of self-help in Europe, and a recognition that it needs to navigate between that's more effectively.
Rick Lakai with us. We're thrilled he's with us here. Of course, after the cacophony of last night, it's nice to actually talk about the 2-year, 10-year German spread as something maybe more civil and a better discourse. Rick Lakai of State Street Global with us, and we will continue. In our next hour, fired up, Noel Rubini of New York University's Stern School. Not only Noel Rubini on the American economic politics, but a good time to speak to Dr. Rubini about the Levant and the tensions from Turkey to Israel. This is Bloomberg. Good morning. Futures -30.
The scale of the climate crisis is just staggering, but you can't let that be an excuse for doing nothing. So to fight climate change, we can't be overwhelmed by the seeming impossibility of the task at hand.
Inclusive multilateralism is about bringing more voices to the table, resulting in more ideas, more solutions, and more climate action.
As a signatory to the Global Covenant of Mayors, Charlotte has joined thousands of cities and regions in a commitment to accelerate ambitious, measurable climate and energy initiatives.
Local communities across our nation are stepping up in unprecedented ways to respond to the ongoing challenges of our climate crisis.
We'll see what is the cost, what is the reliability, but without innovation, a lot of innovation, we won't be able to get there.
Everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
The second half will be a lot stronger than the first half in China. We're heading to what we call the golden season of auto sales.
We are very confident, we're going to have another big growth, 2021 versus 2020.
We did not see people kind of holding back.
Chinese customers are into, right now, buying individual mobility.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. Bloomberg's learned that Boeing will move all assembly of its 787 Dreamliner to South Carolina. That's a blow to the Seattle area and Boeing's unionized workforce there. It's not clear how many employees will be affected by the move. Boeing had said in July it was studying options to handle a slowdown in demand for the 787. Caesars Entertainment is acquiring a significant footprint in online gambling. The board of William Hill has accepted a $3.7 billion takeover bid from Caesars. That represents a 25% premium to the British company's closing share price before Bloomberg reported takeover interest on Friday. And Apple's giving CEO Tim Cook new equity awards that could provide him with as many as 1 million shares by 2025. That could be worth up to $140 million for Cook. They're the first equity awards he's received since he became CEO in 2011. Cook became a billionaire earlier this year. And that's the Bloomberg Business Flash. Tom, Francine.
Rutika, thanks so much. Now, U.S. equity futures are actually down along with European stocks. The European stocks are down some 0.2%. It was pretty acrimonious, the debate. And I guess there's a little bit of a bet in the markets that it could lead to a really contested vote in November. A gauge of the dollar edging higher, WTI oil hovering near $39 a barrel, and treasuries holding steady, Tom.
All fragile moves, and of course we go to claims tomorrow, Thursday, and then on to the jobs day on Friday. And right now, a little less of a churn than what we saw yesterday. Again, I want to underscore yields come in. The two-year yield to 4 digits, 0.1211, really gets my attention. That's 5, 6, 7 days in a row in. Let me give you a Turkey update. Noel Rabini to join us, I believe, in the next hour. Turkey, 7.78. It's a little bit better than the carnage yesterday, but certainly things are very fragile there. And looking quickly, Argentinian peso, 76.11, again, underscores the troubles in Argentina and moving forward as well. This is a joy. Our Michael McKee with Mr. Barkin of Richmond. Everyone stops by McKinsey for a 2-year stint. Not Thomas Barkin, 3 decades at McKinsey, including as their chief financial officer. Mr. Barkin now holding court at a very different Fed, the Richmond Fed. Thomas Barkin with our Michael McKee. This is extremely well timed. Really looking forward to that with all the different speakers out there. Barkin always organized and consulting on the American economy. Futures at -34. Stay with us. This is Bloomberg.
Ladies and gentlemen, I closed position on euro. 2 positions, as you can see from ticker, that was open from 116.20 and 117.415. Position closed at 116.99.
Friday, it is the main event.
It is the US payrolls report. From New York, this is Bloomberg.
My take on what's going to happen November 3rd is anything can happen. Trump can win, Biden can win. There can be total confusion and chaos for not just days, but maybe weeks, or God help us, longer, about who's going to be the next president. In this era when people distrust everything, especially the media, Trump's voice is the most recognizable voice in the world, perhaps. Put it out, and then people can hear it for themselves.
Bob Woodward, with a very generous interview yesterday, really the newsmaking there was he really didn't want to release the tapes of his conversations with the president and his wife, and someone over at CNN really pushed him to do that. And of course, that has changed the rage from just another book to the immediacy of direct quotes and transcript from the president of the United States. We certainly saw that last night in this debate. Rick Lakai with us of State Street. We've been talking about investment, finance, maybe a little bit of economics. Rick Lakai, I want to fold in the politics. I'm not a big fan of linking politics into investment decisions, but clearly we have a Trump-Biden wall of worry. Describe that wall of worry and what's it mean for those trying to allocate capital?
Well, it's mainly in the equity implied volatility and the currency implied. Credit is quite well behaved. So you could say that credit markets are looking at central banks, the level of support, they're reasonably comfortable. That's where we're a little overweight. I think we're factoring in a substantial level of disruption around the election, but it's not going to last forever. The most interesting thing is how sectors perform, whether it's US sectors primarily, but even in Europe. You're seeing an enormous range of outcomes. And you saw it the last election, you will see it this one, whether it's healthcare, utilities, some of the industrials that I think are good value. There's going to be some interesting plays, and I think we should get ready for that now.
You know, I'm typing out here, folks, as we structure the BAMRs, the phrase Obamacare, but I always call it the Affordable Care Act. Actually, Rick, there was a little bit of almost sane discussion last night about the view forward for our health care system. Does State Street Global have an overweight, equal weight, or a befuddlement about healthcare equities?
I think we may have a bit of technical difficulties, Tom.
I caused that. I'm sorry.
I think we do.
Yeah.
No, okay. Should we do a market check, Tom, and then we'll try and get Rick back on the line to give us, you know, a bit of an update on some of the things he's expecting also in Asia.
Well, some of the things. Thank you, Francine. Some of the things that we see here in the markets today, and of course into jobs. And I'm going to go to the bond market where Mr. Lakai was noticing the quiescence. The 2-year yield 0.1211. Look how our team nails that. Total chaos in the control room. No one slept last night. And they nail it with the 2s, 10s, and 30-year bond board. I love these guys are great. 4 digits on the 10-year yield 0.6479. And critically, the 30-year stuck at a 1.42. The real yield, Francine, comes into negative 0.9931. That is a greater negative yield over the last 24 hours.
Yeah, Tom teary-eyed because we got the data check on time. Investment
Either
firms
that or it was a third scotch last night.
Recalibrating some of the positions, Tom, on the final day of this quarter. Something that we also need to look out for is, of course, Walt Disney shares falling in pre-market trading. It did say that 28,000 workers will be let go in its slumping U.S. resort business. This means it's one of the deepest workforce reductions in the COVID-19 era. So look out for Disney and maybe some of the repercussion in the leisure industry.
You know, we're going to talk about this, but I'm so glad you brought it up, Francine. I mean, these are big numbers. We're benumbed by, you know, COVID and pandemic and 5,000 here, 9,000 there. But let's remember, these are really big numbers beginning to add up into millions of underemployed and unemployed. With our first word news, in New York City, here's Ritika Gupta.
Thanks, Tom. Francine. Last night's presidential debate in Cleveland made one thing clear. The two candidates can't stand each other. President Trump and Joe Biden hurled insults throughout the hour-and-a-half-long event.
He's a liar.
But you
I just
agree.
want to make sure.
Joe, you're the liar.
I want to make sure.
You graduated last in your class, not first in your class.
I want to make
Mr.
sure.
Mr. President, can you let him finish, sir?
No, he doesn't know how to do that. He has,
You'd be surprised.
You pick
You'd be surprised.
the
Go ahead,
wrong
Joe.
guy, the wrong night at the wrong time.
Listen, you agreed with
Here's the
Bernie
deal.
Sanders to the manifesto.
The whole idea.
Let him disavowing.
There is no manifesto. Number
Please
one.
let him speak, Mr.
Number two.
You just lost the left.
Number two.
You just lost the left. You agreed with Bernie Sanders on a plan.
Folks,
absolutely
folks,
agreed
do you
to,
have any
and under that
idea
plan,
what
you
this clown's
socialized the
doing?
Moderator Chris Wallace of Fox News tried to stay in control, but had little success. The Trump administration reportedly has wide-ranging immigration enforcement arrests next month. According to the Washington Post, the raids would take place in cities and jurisdictions that have adopted so-called sanctuary policies. The move is seen as amplifying the president's law and order campaign message. American and United Airlines are amongst 7 carriers taking federal loans to help stay afloat. Those loans are capped at $7.5 billion each. Companies accepting the loans are required to put a cap on executive pay. They also must offer the government equity or other financial stakes. And Disney is making one of the biggest job cuts of the coronavirus era. The world's largest entertainment company is cutting 28,000 workers in its slumping theme park, cruise line, and retail businesses. 2/3 of those being let go are part-time workers. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom Francine.
Thank you so much, Ritika. Let's go back to Rick Lacayo, State Street Global Advisors. Rick, actually, I wanted to ask you something on the haven currencies. I don't know what you do with Swiss franc and yen right now.
Sorry, can you repeat the question?
Rick, I was asking about Swiss franc and yen. Given the conversations we were having on fixed income and inflation, you know, what do you do with some of these haven currencies?
Yeah, I think the havens have changed. At the moment, it's the yen, so we're quite long of the yen. The US dollar has been a haven, and I think we have to look at it as being a long-run haven, but we've got a somewhat bearish position on the US dollar, at least for the time being. And that allows us a bit more space in terms of risk budget to go long, also some of the value currencies in the Scandies and sterling as well. But it's not easy to find a safe haven. That's why we've got gold in a lot of portfolios as well.
Rick, I mean, you mentioned sterling. Are we going to see negative rates here in the UK?
It's a close-run thing, but I think not. I think there's an institutional reluctance and there's a very big concern around the kind of operational issues, just as there is in the US. I wouldn't say it's ruled out, but I would assign a low probability to that in the UK.
Rick Lacayo, thank you so much. With State Street Global Advisors, Rick, we're sorry for the technical difficulties there, and we'll try to straighten that out here with the rest of the morning as well. Mr. Lacayo, on the markets that we see now, negative 31 Dow futures, negative 267. John Farrell holding court in London on the open this morning. Michael Wilson, Morgan Stanley. We'll get an update on the back and forth of bull and bear with Mike Wilson, the equity view of Morgan Stanley. Coming up, sleepless in Cleveland, Mr. Cirilli. This is Bloomberg. Good morning.
defying this retail downturn?
The function of luxury, I think, since the very beginning is the same, is to give pleasure to people. And probably in this period of time, people need pleasure more than ever.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
If we would have listened to you, the country would have been left wide open. Millions of people would have died, not 200,000.
Between 750 and 1,000 people a day are dying. When he was presented with that number, he said, it is what it is. Well, it is what it is because you are who you are.
Many of your Democrat governors said, President Trump did a phenomenal job. We got the gowns, we got the masks, we made the ventilators. You wouldn't have made ventilators, and now we're weeks away from a vaccine.
You should get out of your bunker and get out of the sand trap and get in your golf course and go in the Oval Office and bring together the Democrats and Republicans and fund what needs to be done now to save lives.
You could never have done the job that we did. You don't have it in your blood. You could have never done that job. We're going to deliver it right away. We have our military that delivers soldiers, and they can do 200,000 a day. They're going to be delivering.
This is the same man
It's
who
all
told
set
you
up.
by Easter this would be gone away. By the warm weather, it'd be gone. Miraculous, like a miracle. And by the way, maybe you could inject some bleach in your arm, and that would take care of it.
Oh, it's even more painful to relive it on this morning with 4 hours sleep. Good morning, everyone. Bloomberg surveillance from New York and London. Francine Lacroix and Tom Keene. The highlight of the debate for me was the understanding by the President of the United States that those losers, the Philadelphia Eagles, have to play the 49ers coming up here. Kevin Cirilli joins us, our chief Washington correspondent, because bad things happen in Philadelphia. But, Kevin, politicians don't say bad things happen in any given constituency, do they?
Good morning to you too, Tom. Look, it was a brutal debate, but let's spin it forward, right? And there was really one moment that I think, if you drown out all the noise, you cut to the chase here and just focus on what's lying ahead. The final 5 minutes of that debate really set the stage for the next, dare I say, 2 months, because President Trump and Joe Biden both vowed to fight if it means ending up in the Supreme Court, if it means encompassing a Supreme Court nomination in Amy Coney Barrett, through all of the mail-in ballots. And that really was my biggest takeaway. You had President Trump dig in, Vice President Biden dig in their own respective ways about this could really go all the way to December. And that's a lot of volatility, and it's lumped into a Supreme Court battle nomination.
Hey, Kevin, what will we learn or accumulate in knowledge before Steve Scully does a town meeting in Miami October 15th? How much more knowledgeable about this race will we be that evening?
Well, listen, I don't even want to throw out any shots because it was just so incredibly loud and confusing. They were talking over one another. But from a strategic standpoint, the Biden campaign, with his strategy, and it was a strategy last night, really went after the working class vote. It showed a confidence in the Biden campaign to try to make inroads in what largely is President Trump's stronghold, which is the white working class male vote. And so as a result of that, when Joe Biden gets on an Amtrak train in the coming days and tours through parts of Ohio and parts of western Pennsylvania, Connor Lamb country, who I spoke with yesterday, mind you, he is really trying to make inroads not with the far left and the base, but in Trump country, in Trump-based country, to try to shore up this election. I said to Connor Lamb before the debate yesterday, who, by the way, was in the inner orbit of Joe Biden's campaign, I said, you flipped a Trump district in 2018. What did you do that Hillary Clinton didn't do? He said he talked about pensions and he talked about the economy. And really, at this point, with all of the show and tell and the theatrics, dare I say bad theater, of the presidential debates, it's going to come down to those message in those parts of the country, Tom.
Okay, so Kevin, do we see it in the polls? Is it too soon to see it in the polls, or, are people's mind largely made up no matter what happens in a debate?
You know, look, when I was talking with some Trump sources yesterday, and I spoke with Mark Meadows briefly before the debate, he, of course, is the president's chief of staff, and about just the strategy for the president and where they feel they're going. They're going to double down on the base. It's also, in a sense, last night's debate was so incredibly toxic that you have to wonder whether or not people who are undecided or people who sometimes don't vote in elections, if they're going to be motivated to get to the polls. I mean, that thing was so brutal that it really, you start to question whether or not there will be a massive type of turnout election. And Frank Luntz said that, by the way, one of the best pollsters in the business, to our David Weston after the debate last night. I thought he nailed it in terms of just the debilitating effect that this toxicity could have on some of those voters who are just going to say, I'm tuning this off. I'm tuning this right off.
So, Kevin, what will the candidates change in the next debate? Is it tone? Is it more focused on policy? And, you know, the role of the moderator could also be quite crucial.
Well, Steve Scully of C-SPAN, who's got the next debate, and that's in about a week and a half, 2 weeks. Next week is the vice presidential debate in Salt Lake City, and then we head to Miami, Florida, where they've got the second presidential debate. I mean, look, you know, in terms of policy, if you study the transcript last night, we were able to glean some new details about the dynamic that a Biden administration would look to have on something like energy policy, for example, where he said, as it relates to the coal industry, that there are no more coal plants that are going to be opening. He's continuing that shift towards new energy that, quite honestly, might not play well in battleground states where fracking is so incredibly important.
Kevin, the tweet of the night was David Brooks of the New York Times with his laptop open to the debate and a three-finger scotch in front of him trying to get through the evening. David Brooks speaks to the suburban voter in this country. What did the suburban marginal voter take away from last night's theater?
It was a bad reality television reunion. I mean, it was, I'm not sure you can. I mean, and you know, I don't want to get on a, you know, look, I think if you move it forward, I think it was a toxic level debate. It was incredibly difficult to try to glean any policy substantial discussion. But at the end of the day, I mean, this is the political moment we have in, and I think what some suburbs are deciding is this could be a prolonged battle.
Okay, Kevin, I know you're exhausted, but I got one more question. You've been killing it out in Cleveland and on the way to Miami. Who is coaching the president? Who is advising him at this moment? Is it the immediate family?
Rudy Giuliani. He traveled with the president. Yeah, and I asked that to Senator Marsha Blackburn, Republican from Tennessee. She was on Air Force One along with Mark Meadows, Jim Jordan, some of the ultra-conservatives, Freedom Caucus members who traveled with the president here to Cleveland. And I said, Senator, how's his mood? You know, what's the vibe like on AF1? And she said, Rudy had everybody laughing. He was in good spirits. He was fired up. He was ready to go. But Rudy Giuliani has the president's ear with these debates.
Kevin Cirilli, thank you. Get some sleep and move on. He'll be with us, of course, through the day on surveillance and across all of Bloomberg. He has a rumored radio program tonight, which I'm sure will be quite something. Mr. Cirilli in Cleveland. Futures at negative 31, Dow futures negative 273 as well. Looking at the VIX, 26.88 this morning. Coming up, as Kevin mentioned, the senator from Tennessee on Bloomberg Technology in the 5 o'clock hour. Stay with us. Remember, David Weston at 12 noon. This is Bloomberg.
people afraid of calling you because their own credit ratings might go down if it's known that they have to borrow money from the IMF.
If you're a president of a country in trouble, you better call.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. It could have been the biggest utility deal in American history. Bloomberg's learned that Next Era Energy recently made an unsuccessful bid to take over Duke Energy. Next Era is the world's largest utility owner by market value. The company is still interested in pursuing a deal. Shares of Micron Technology are lower. The largest U.S. chip maker says it has now halted shipments to China's Huawei, its biggest customer. Micron also cut capital spending plans, warned about weaker demand, and forecast possible oversupply. And it's a milestone for Alibaba. China's e-commerce giant sees its cloud services unit turning profitable this year for the first time. Alibaba says the business is growing roughly 60% a year. It's a sign that Asia's largest corporation expects a return to pre-pandemic levels. And that's your latest Bloomberg Business Flash. Tom, Francine.
Ritika, thank you so much. Now, the IMF Managing Director, Kristalina Georgieva, is more optimistic about the economy than a few months ago as a result of the pandemic, but also says the recovery is partial and uneven. While the Carlyle Group co-chairman and co-founder and peer-to-peer conversations host, David Rubenstein, spoke to her about the global economy and the ways working remotely has impacted the organization.
As we talk today at the IMF headquarters, it's relatively quiet here. That's because of the pandemic. People are working remotely. Are you generally working remotely?
So on March 13th, we took a decision to work remotely. And we have sustained this decision because conditions are still such that for the safety of staff, we ought to continue to respect that modality of work. It has been amazingly successful. We are doing much more because of the crisis, and we are doing it working remotely. But it does have some downsides. But David, we would never go back to where we were. We would never have 100% of people sitting here in these offices. We now know that we can be very productive working from home. And we would be striving to have maybe 50-50, 60-40 at any one day being in telecommute, working from home.
What are the economists here telling you about the state of the economy in the world? Because of the pandemic, are we likely to have a kind of global recession for another year or so?
We have some optimism on two grounds. The first one is exceptionally decisive action by central banks and by finance authorities. They put a floor under the world economy. We, on our side, have done our part for the countries that have no resources on their own. The second reason we are somewhat more optimistic today than we were a couple of months ago is that we see the world learning how to function with the pandemic still with us. But make no mistake, the recovery is partial and it is uneven. We are not going to see in 2021 return to pre-COVID conditions, and we are seeing big divergence, parts of the economy doing really well and parts falling behind. And this is my biggest concern, that we may come on the other side of this crisis with more inequality, higher debt, higher deficits, and a climate crisis still hanging on us. If we are strong as a world, we ought to come together. A massive coordinated stimulus can make it so that we have a better economy on the other side than we had in 2019.
The managing director of the International Monetary Fund from Bulgaria there with David Rubenstein. And of course, tonight, 9 p.m., look for that conversation. That will be in the 7 p.m. Thursday time in Hong Kong and London as well. The David Rubenstein Show, peer-to-peer conversations. Futures negative 26, Dow futures negative 230. Next, Nora Robini will join us on our economic politics. Nora Robini on the Levant. This is Bloomberg. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This morning, there's only one question. Can you and America stand another two debates? Amidst the rage, the rancor, Trump and Biden, Biden and Trump, they debate some debatable points. Mr. Biden often turned to the camera and spoke to the nation. Mr. Trump often spoke to the moderator. Surveillance break exclusive. Mr. Wallace survived the debate. Did you? No debating bonds. They're dead in the water. Fact check that. Oh, I'm wrong. The real yield returns to a negative 1%. And Disney to X 28,000. Royal Dutch Shell in London near 9,000. Jobs Day is this Friday. Good morning, everyone. This is Bloomberg Surveillance from New York, from a sleepless London. Francine Lacroix hanging on every word last night. Francine, as a general statement, was London riveted by the debate?
I mean, London is riveted because we've never really seen anything like it. I think if you're a market participant, you kind of get out of the debate and you say, right, there wasn't a lot of politics or policy statements that actually move the needle. you try, I guess, and look at the polls to see who's won it. But the wider, implication is that it was just so chaotic, it was so acrimonious that it made people make people think that actually it's going to be quite hard to get a clear-cut winner, or certainly it'll be very tense. And so you can see this uneasiness in the markets today.
We're focused at Bloomberg. Craig Gordon leading our coverage in Washington on driving the story forward, and the forward is to October 15th, a town hall meeting in Miami. Right now, with our first word news in New York City, here's Ritika Gupta.
Morning, Francine, Tom. It was billed as the first presidential debate, but last night's event in Cleveland quickly slipped into chaos, and insults drowned out ideas. At one point, President Trump and Joe Biden battled over the coronavirus.
He knew it was a deadly disease. What did he do? He's on tape as acknowledging he knew it. He said he didn't tell us or give people a warning of it because he didn't want to panic the American people. You don't panic. He panicked.
We've done a great job. The only thing I haven't done a good job, and that's because of the fake news. No matter what you say to them, they give you bad press on it. It's just fake news. They give you good press, they give me bad press, because that's the way it is, unfortunately. But let me just tell you something. I don't care. I've gotten used to it. But I'll tell you, Joe, you could never have done the job that we did. You don't have it in your blood. You could have never done that job.
I know how to do the job. I know how to get the job
Well, you
done.
didn't do very well in swine flu.
Moderator Chris Wallace kept trying, mostly in vain, to control the conversation. House Speaker Nancy Pelosi is moving lawmakers closer to a vote on a Democrats-only stimulus plan. The $2.2 trillion measure is aimed at breaking the deadlock in talks with the Trump administration. Pelosi and Treasury Secretary Steven Mnuchin are still trying to come up with a compromise deal. And Senate Democrats want Supreme Court nominee Amy Coney Barrett to promise to recuse herself from cases related to the 2020 election. That's after President Trump said the court might decide the outcome, and he expects her to break a tie. Supreme Court justices decide themselves whether to step away from a case. And in the UK, Prime Minister Boris Johnson will try to regain control of his coronavirus strategy. His own Conservative colleagues have warned him that he faces a damaging defeat on COVID regulations today, unless he gives Parliament more authority to scrutinise the powers. Johnson also had to apologise for wrongly explaining the government's new pandemic restrictions. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. The market's south today, negative 27 on SPX. Dow futures negative 244. The VIX 26.69. In the yield space, I really want to focus on the two-year yield. I haven't mentioned that recently, 0.1211, and the real yield comes down. The 10-year inflation yield negative 0.9945. That's a real reversal over the last 48 hours. With the disinflation and deflation out there, and dollar, Francine, as you mentioned earlier, fractionally stronger.
Yeah, dollar fractionally stronger. If you look at some of the support for sterling, there was a lot of talk with the chief economist of the Bank of England about possible negative rates, the fact that it will actually take quite a long time to even study the effect it would have on the economy. The futures are falling, and so are European stocks down some 0.4%, Tom.
Very good. We're going to dash between economics, finance, and investment, and, of course, how all of us are riveted by the politics of the moment. In case you're unaware, there was a debate last night, for those of you that slept in. Huge interest in this debate, and it was on fire. Let's listen to selected moments.
Everybody knows he's a liar.
But you
I just want to make sure.
Joe, you're the liar.
I want to make sure.
Graduated last in your class, not first in your class.
I want to make
Mr.
sure.
Mr. President, can you let him finish, sir?
No, he doesn't know how to do that. He knew it was a deadly disease. What did he do? He's on tape as acknowledging he knew it. He said he didn't tell us or give people a warning of it because he didn't want to panic the American people. You don't panic. He panicked.
We've done a great job. The only thing I haven't done a good job, and that's because of the fake news. No matter what you say to them, they give you bad press on it. It's just fake news. They had the slowest recovery since economic recovery since 1929. It was the slowest recovery. I paid $38 million 1 year. I paid $27 million.
Show us your tax returns. Nobody's doing that. He's the racist.
You just don't know.
Here's the deal. I know a lot more about this.
Let him finish.
The fact is that there is racial insensitivity. People have to be made aware of what other people feel like.
It is broken. That is one thing we can all agree on. It is so far removed from the modern debate and certainly removed from the grace of Kennedy-Nixon of 1960s. Widely anticipated. Jeannie Zaino of Ionia out with a book here with Palgrave called Broken. And I mean, Jeannie, let's go right to your book. You have to rewrite a chapter on this broken system?
You know, I very well might, and I have to agree with you. You know, this was, you know, like nothing I've ever really seen. You could hardly call it a debate because there was very little focus on debating the issues and just really an attack fest, needling, disrupting, back and forth, lack of decorum. And it left, I think, so many of us as viewers and listeners throwing our hands up and not being able to quite make sense of what was going on and the point of it all was. I'm curious to see how many people stuck by for all 90 minutes of it.
Oh, I think we'll see those ratings. They come out, I'm guessing, folks, late morning and then a second look in the afternoon as well. Professor Zaino, I want to go to the process here of a moderator that's from Journalism Royalty and Chris Wallace. And we go to the wonderful Steve Scully of C-SPAN, October 15th, in a town hall format. And Scully is the real Midwest deal. He's one of 16 children. The guy is total journalism and straightforward. What's he going to do after witnessing this to help us survive a second debate?
Yeah, I was thinking that same thing as we got about 15 minutes into the debate about Steve Scully and then Kristen Welker, who follows him in Nashville on the 22nd, I believe it is. And, you know, I think one of the things people are discussing is that if the candidates do not agree or are unwilling to follow the rules, they may have to cut microphones. I'm not sure beyond that what you can possibly do. Yeah. And I have to say, I'm not sure that Chris Wallace deserves all of the criticism he's getting because you don't have a lot of options when people agree to rules and follow them.
And this is important, folks. Francine has a slider in London so she can cut my microphone at any time. She demanded that about 3 years ago.
But I don't need to because we're always on the same page, Tom. Professor, when you look at you know how the two candidates actually came across, do they have to change style in the next debate because otherwise it will backfire with voters?
Yeah, I mean, this was my big takeaway was, sure, the president was able to stop Joe Biden from, you know, really achieving what he wanted to achieve. But in so doing, he didn't accomplish his own goals. I mean, we have to, you know, the president has to face the fact he's behind, needs to reach out to seniors, to suburban women, a huge loss for him at this point, according to the polls, and college-educated voters to show a Republican base like he did in 2016 to pull up in Western battleground states. Hard to see how last night helped him accomplish those goals. And so I think from that perspective, neither one won, but the president who was behind able to move the needle. That said, these debates are hardly determinative, and there are still 2 more to go, and you know, about a month. So he's got a little bit of time early putting aside.
So, Professor, how do both actually reach that demographic? Is it on policy? Is it what do they care about?
You know, I think there are very few undecided voters at this point, and I think, you know, the president has got to do a better job of approaching women in particular. This race has always been about suburban women, and I'm not sure that performance last night gets that group. It was more of a reach out to the base. And by the same token, Joe Biden, you know, it's not enough for him to just reach out. He's got to energize his own base. And I have to say, I did not think he did a good job of doing that at all last night. I think the president did succeed in making Joe Biden look frustrated, flustered. You know, he was resorted to name calling and those kinds of things. I don't think that's going to either energize the Democratic base, make them feel confident, or those undecided voters in the battleground states. So I think all in all, we end up with the status quo. Maybe, you know, Joe Biden squeaks by if you believe the polls, but I don't think Americans are going to feel good about this.
Jeannie Zaino, thank you so much. Professor Zaino of Iona College and, of course, a Bloomberg contributor here this morning. Futures at -29, Dow futures -255 here as we go to claims tomorrow, 8:30 a.m., and then Friday, Jobs Day in America. I'm Bloomberg Technology, the 5 p.m. hour, the senator from Tennessee. This is Bloomberg.
it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It is not about moving the goalpost for monetary policy where it is suitable. It is about future-proofing how we measure inflation. But we also need to recognize that adjustments will have issues in terms of reliability and frequency of data.
Christine Lagarde, very visible in the last number of days at the ECB, managing the message forward on a diminished toolkit. Right now, on any number of topics, we're thrilled that Nouriel Roubini could join us with New York University Stern School of Business and, of course, NourielToday.com as well. Nouriel, we want to save the American politics for a bit on here. I want to address the moment for Europe, and then I must speak on the Eastern Mediterranean, where you are in Israel right now. First on Lagarde, the disinflation and deflation is chronic. You have been so good over the years about the chronic condition. Give us an estimate of the chronic nature of our dearth of aggregate demand, of our diminished inflation, and what it means for all of us listening and watching.